as ever for Credit Suisse, even after all the pain they've been experiencing, while also giving confidence to existing clients that they will exist, that they are just fine. How do you do this? To your point, cutting yourself to growth is a very difficult thing. To your point, Tom, when do regulators step in? When does it become a systemic issue? People are saying no, and pretty much consistently, this is a business that isn't viewed that way anymore. So at what point does it really have the regulatory attention?
Macarena Munoz has it at Bloomberg News. Thank you, Macarena. Kian Abasan, this is at Abosina, rather, at JP Morgan. I'm going to just read it verbatim. Cuts earning estimates by 45% for next year, 33% for 2 years out, and cuts earnings estimates 26% with the James Diamond crystal ball out to 2025. I mean, on the sell side, when JP Morgan talks, people listen. I just want to know how they're getting along day to day with wealth management.
I want to read you the quote from the UBS chairman verbatim as well, Tom, because he was much more diplomatic than maybe that headline would lead you to believe. This is what he said at a conference in London on Wednesday. "We're not actively benefiting at their expense. We view them as a worthy competitor going through a crisis, which I believe they will manage and get to safer ground. But we are also in a world of clients moving money around, Tom, where clients proactively approach us." There's going to be winners and losers. Look, I will say this. We all know some supremely talented people who work at Credit Suisse.
Absolutely.
I wish them the best of luck, Tom, in the same way that we did with Deutsche Bank.
I was lost in Bahnhofstrasse once. I walked in the front door and the receptionist asked, I said, "Where's the Hermes store?" And they pointed me down the street. Down there.
I'm pleased you got to the important stuff this morning.
That's the important stuff as well. Let's look at the U.S. economy now. What we're going to do is dive into the labor economy of America. We've got claims today and, of course, a critical jobs report tomorrow. Rabila Faruqi joins us now, chief U.S. economist with Carl Weinberg at High Frequency Economics. Rabila, what is the distinction of what we're going to hear Friday, tomorrow at 8:30? What matters to you and Carl?
Good morning. Thanks for having me. What we're really looking at beyond, the usual, headline job numbers and the participation rate, it's wages, right? Chair Powell made it very clear yesterday what they're focusing on in terms of the inflation, dynamics, and that is what we're going to be looking at. We're looking for a very small deceleration, but really very far above where the pre-pandemic trend was, very far above with what the Fed is saying is consistent with the 2% inflation target.
Right.
So, just definitely is going to be something we're focusing on, but not something that we're going to see, imminent improvement on either.
I want to dovetail with the academic zeitgeist that's out there, Rabila, and this is the academics saying maybe the labor participation rate is not accurate because of the pandemic and older people retiring. Is this good math that we see Friday?
I mean, we've seen this adjustment, right, post-pandemic, where you've seen excess retirement. So we really shouldn't be looking for the participation rate to improve too much. But if you remember, before the pandemic, when the labor market was strong, job growth was strong, but people were coming back into the labor market. So what is the dynamic here? Is growth going to slow enough that people will want to get back into the labor market? Are their savings going to diminish enough? Is the cushion from, the income support that they've had, is that going to dissipate and they are going to be motivated to come back into the labor market? Certainly a possibility, not our base case right now, not the Fed's base case, certainly. If you heard Chair Powell yesterday, that's not what they are expecting to see. So I think those dynamics, that post-pandemic distortion, is probably going to last for some time.
Rabila, you mentioned Fed Chair Jay Powell in his speech yesterday. A lot of people thought that it was more dovish than expected. At least he didn't come out with a hawkish rebut of some of the gains that we've seen in the equity markets. However, to your point, he talked about the labor market tightness and how significant of a concern this is for him. How much do you view that as causing the Fed to raise rates higher than the market is currently pricing in, even after yesterday's rally, even after yesterday's perhaps shift slightly in tone from Jay Powell?
So, what I heard from what he said yesterday is that higher for longer, right? Rates have to rise further. They don't really know how restrictive because they don't really know where that level is. But certainly, we're going to move higher. Our base case is they're going to go 50, then another 50 in the first quarter, top out around 5%. But if the labor market does not start responding, our base case is it is, right? I mean, 5 percentage points of rate hikes, we don't see how the economy doesn't respond to that. But if we don't see the type of improvement we need to see and we don't see sustained easing of wage pressures off of these levels, 4.7% to maybe 3.5-ish, then yes, certainly there's this risk that rates move higher. But I think what markets really need to understand is that the Fed does not want to over-tighten now, because then crash the economy and then come out on the other side and ease rates. So they're going to go gradually. They're going to watch what's happening in response to what they've already done so far. And then they're going to see how long they need to stay there. We think that, they reach peak rate, whatever that rate is, in the first quarter, and then they stay there for the rest of the year, at least, to see that sustained, improvement in inflation from a slightly restrictive policy stance.
People would push back, including Ben Laidler, who says that if you look around, there is disinflation everywhere. Is there any area where that's not true, where you're starting to see inflation starting to reaccelerate?
Well, I mean, what we're seeing is inflation readings right now are still not that far off peaks. I mean, 7.7 on the CPI, down from 9.1%, quite substantial, but still way above target. For PCE accelerating, we're going to see we expect to see a slight deceleration, but these are not levels that are consistent with, what the Fed wants to see. Yes, there are signs of disinflation, but on the good side, services inflation is still very sticky. What Chair Powell talked about in particular yesterday was that core services ex-housing, and that, has a strong wage component to it. So adjustment in the labor market, rebalancing is necessary so that those wage pressures can come under control, which will give them a little bit more room, to sort of adjust to see where we're going from here.
For a man who said there wasn't space for nuance at the last news conference, I have to say there was a lot of nuance yesterday in a way that I didn't anticipate. Rabila, fantastic, as always. Rabila Faruqi there of High Frequency Economics. Pushing ahead to payrolls on Friday, Lisa, looking for 200K. That is the median estimate in our survey, 200,000. The previous number was 261.
How real are these numbers, right? I mean, that was something that you both were talking about earlier, especially given that Jay Powell said that the reason why the participation rate hasn't come back is because of early retirements, that 2 of the 3.5 million job openings are due to people who brought forward their retirements. To me, that's fascinating. And whether we see that actually borne out in the data remains to be seen.
I looked carefully at real wages today, particularly off of Olivier Blanchard's essay in the FT, looking at 3% inflation for the long term. And the bottom line, if you take a presidential moving average, a 4-year moving average, we're getting down to the tension point where the real wages have been negative for a long time. We're not quite there yet, where the pain really clicks in socially, but you see it in the strikes. And John, the strikes in the United Kingdom. Should anyone watching or listening, should they fly to London for the holiday season?
You want me to tell them not to? I'll tell you what I'm doing. I'm going.
You're going?
I'm going, of course.
What about the strikes here? The strikes here, the Royal Mail? Is that what they call it?
Royal Mail, the postal.
Dear, the Royal Mail's here. What do they call the postal?
What are you up to? What's going on?
What, for the holidays?
Yeah.
Nothing. I'm going to tuition.
You're not going away. You're just paying tuition.
Right now, it's like 50-50. We don't know what we're going to do.
All right.
Is
this you crossing London off the list? Are you telling the other half we can't go to London?
This is London crossing Tom off the list after this.
We can't go to London this year because of the strikes.
Yeah.
And Mrs. Keen's like, oh, I didn't know.
Yeah.
Can you ask Tom? Can you ask John tomorrow?
Can you take the train from London to
you
Paris?
can clip this just for Mrs. Keen.
Yeah.
Don't go, Tom. Don't go. The strikes are going to kill you.
Thank you.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is set to slow the pace of raising interest rates this month. In a speech Wednesday, Fed Chair Jerome Powell signaled the unprecedented run of 4 75 basis point hikes could come to an end at December's policymakers meeting. He also made a case for achieving lower inflation without sending the country into a deep recession. A House committee can now look at 6 years of Donald Trump's tax returns. The Treasury Department has complied with the Supreme Court decision and delivered the documents. The Ways and Means Committee meets today to decide what to do with them. The panel could vote to release them or a summary of their findings to every member of Congress. The average British household is paying a price for Brexit. According to the London School of Economics, the spill from the European Union has added 6% to food bills. A study says that's due to additional business costs by so-called non-tariff barriers in the form of border checks. A new survey says that New York and Singapore are the most expensive cities to live in. The report comes from the Economist Intelligence Unit. Tel Aviv, Hong Kong, and Los Angeles round out the top 5. The survey says the cost of living in the world's largest cities rose more than 8% over the past year. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Big risk, and probably in 2023 we're going to see many countries in recession. Right now we've got both the U.S. and China showing some signs of weakness in the numbers that are coming out.
It was David Malpass there, the World Bank president, on the latest in the global economy. The latest in global markets looks a little something like this. Equity futures down 0.1% on the S&P 500. Big month of gains for November, helped out by the monster move we saw on a final trading day of November. The S&P 500 up last month by more than 5% after a monthly advance, Tom, in November. We had a monthly advance in October, up 8%. So we've had some big back-to-back monthly gains on the S&P.
And it's the quality of it. I don't want to get into it now, but I just think profit and quality have value now, whatever the factors are. Bloomberg Intelligence with their new study of value and growth. And it comes back to, John, a select group of companies showing profit. And the rest of them, like DoorDash, are like,
sure,
now what do we do?
The debate right now between bulls and bears, not about the Fed speak, comes down to the data, it comes down to the earnings. And I think more critically, it comes down to the earnings that you will see in the first quarter of 2023. Because to see Marko Kolanovic of JP Morgan on board with Mike Wilson and Morgan Stanley.
What's that about?
There we go.
Mike Wilson's scheduled to be with us, right?
Looking forward to catching up with him in about an hour and 10 minutes time, yeah?
Yeah,
There's nobody there.
You can't keep up. Well, it's the entourage. Let's do this right now. This has been hugely anticipated. Leland Miller joins us. He is expert on China with Parchment from Washington and Lee from Oxford and the language study in Taiwan. He is definitive. Leland Miller, the China Beige Book needs to be rewritten, and it's about, quote, China's going to open. What does that exactly mean? When people like John and I and Lisa say China maybe is going to open, what's that mean?
Well, it means a lot of different things to a lot of people right now. In the short term, you're seeing this a response to the government, to the protests against the government. The government is acknowledging protesters' frustration with the draconian aspects of COVID-0 and has been easing and has been changing the language, changing the narrative, and has been signaling that, the days of really being locked down and having your life torn apart, that's over. So a lot more freedom of movement. So from that perspective, people are seeing a move towards reopening. The problem here is the backdrop, and the backdrop is quite scary with rising COVID cases. And you're seeing a weakening global economy, and you're seeing some of the worst China data that we've seen in a long time. So it's not altogether clear how you can get from this stage of reopening to the next stage of reopening without some serious problems along the way. Serious problems.
Before we even get into just some of the problems and whether they really have enough willingness to move away quickly to really upend some of the projections on Wall Street, what's the stealth move like by international businesses away from Chinese factories, especially given all of the uncertainty right now?
Well, it's been building for years. You saw corporates start to rethink their strategies and their supply chains because of geopolitical tensions, then the trade war, then COVID, and then COVID-0 really cemented that they had to have a plan B or a plan C. So this is happening amidst the slowing economy and tensions between the two powers. So you've got a few dynamics that are on top of that are weighing on the economy in addition to just COVID-0.
Well, and I wonder how much that is the reason why there is this willingness to move away from some of the stricter COVID policies, not necessarily the protests. We've seen China in the past not necessarily cave to protests or social uprisings. Is this really a response to international business and to the deterioration that you're seeing in the underlying economy, perhaps beyond what they previously saw in the past couple of years?
Yeah, I think it's a combination of several things. Obviously, the government protests are a big factor. They are worried about businesses leaving China to some degree. But I think that right. There has always been there hasn't been a game plan for figuring out COVID-0, and I think this just expedited the potential exit.
Leland, I'm going to rip up the script here. I was appalled yesterday by the major Western media's coverage of the death at 96 years old of a previous leader of China who was hauled out of Shanghai as a mayor to take over after Tiananmen Square. Now they've got a new leader codified with a party Congress. How close is his protege Xi to what we saw from Xing?
Well, it's a very different type of leadership. Zhang was the beginning of the institutionalization of the current set of rules, which Xi just broke by taking a third term. So I think Zhang thought that he was solidifying the economy by creating norms, creating institutions, creating rules around the leadership. And Xi thinks in order to fix China or to save China, he needs to break all those rules. So it's quite a contrast.
Leland, what did you make of Xi Jinping at the G20? Were you impressed by his performance there?
Yeah, well, we haven't seen him interact with non-Chinese for a long time, so it was interesting. I think that 2023 is going to be a year of a charm offensive for the Chinese in Europe and other places, trying to push back against what they see is a coalition building against advanced technology, ring fencing, and trade and military aspects of the relationship. So I think China is going to sort of turn around some of this in 2023 in terms of being so completely inward looking. But again, they've got a long ways to go. They haven't been on the world stage for several years.
I think we see a little bit of that this morning. Leland, thank you. Leland Miller there of the China Beijing. We had Xi Jinping sitting down with the European Council President Charles Michel over in Beijing, and this is what Xi said this morning. Solving the Ukraine crisis through political means, Tom, is in the best interest of Europe and the common interest of all countries in Eurasia. It is necessary to avoid escalation and expansion of the crisis. That charm offensive that Leland is talking about, pushing back against that coalition building against China. Let's see if that is a key feature of 2023.
How do you do a charm offensive with the one thing that Republicans and Democrats agree on in Washington?
That's his problem right now, sure.
I mean, I don't know how you project that forward. The Secretary of State has been in Asia. I don't know how you project that forward. It's a huge mystery to me.
If they're able to, if Xi Jinping is somehow able to step into what's going on in Ukraine, that would be a charm offensive that would get people's attention. If they really reversed course in some kind of way and said, you know what, we're going to actually take a harder line with Russia, perhaps that would have more influence. But are they willing to go that far, or is this just simply what it is, which is charm offensive?
I'll defer to Leland Miller. They're going to go back to what they've always done, which is goose state-owned enterprises, goose the export industry, blah, blah, blah. We've all seen it a million times. That's how they get back to 5% real growth.
Well, Lita and I have been talking about this. The tension right now that's interesting to me is not Europe and China. It's actually Europe and the United States over the same issue, state aid and the Inflation Reduction Act. So when you get that meeting of minds between the French leader and the American leader a little bit later today, if there is any tension right now, it's over that. It's over that, and it's going to be interesting, TK, to see how it plays out down in Washington.
Well, and let's be honest here, 104 euro off the gloom that we had 6 weeks ago. I mean, is anyone framing out that Europe gets its act together, that Ukraine gets better, that Mr. Putin slips away in whatever way, and all of a sudden you've got 120 euro? I don't hear a single body talking that.
It's not the winter people feared. Let's be clear about that. I think we had the worst case scenario with Nord Stream shut off, but ultimately they got storage capacity up to the levels they wanted it to be, and they were blessed with a milder winter, let's say. So far, so good. The challenge for Europe is to repeat the act next year. To repeat the act, get storage levels up.
I think
without Nord Stream.
I think the only solution is we need a trip to London here. It's January, February.
We can't do that. The strikes, TK.
You could do it in January, just not December.
Do it in January. 2 weeks in London. I think it gives us
Future's negative. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind and open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Central banks are not going to go all the way to fight inflation to bring it down to target.
We don't necessarily think the path to a soft landing is completely closed either, but we do think it's getting narrower.
The supply side on inflation is not fixed. The Fed knows that, and they're going to be keeping things tight.
I think you have to take that as a signal that they're willing to do more rather than less.
The biggest concern is that inflation's been around for long enough that it's become entrenched in the labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Why is Lisa so rude to us in the commercial breaks?
It's just unbelievable.
I don't get it.
People were doing all this weepy tear. We've been together since time began.
I know.
What you people don't understand is when we go to break, we don't even talk to each other. We sit here. It's like,
can we just mark that? Can we take a minute? Yeah. It is our anniversary today.
Congratulations
Thank you.
to two wonderful people.
Just December 1st, a long time ago.
Changed our world.
I remember that meeting.
Destroyed it, actually.
Lasted about 10 seconds. Would you like to do radio with Tom? I said no. And they said, you'll be doing radio with Tom. And I said, okay. And it went from there. And then I think from there, Tom, I think people spent the last however many years trying to work out whether we actually like each other or not.
I'd include Lisa in this as well. There's and the truth is, folks, we all can't stand each other's guts. I mean, you know, it's the way it is. But within the stresses of this, what we all agreed on, and what you and I agreed on right from the start, is that the data and the conversation matters, and not all the whiz-bang garbage of TV. And we're fighting for that every day.
I'm going to set the record straight. Meeting you changed my life. I love you.
Shut up.
All right. Equity futures look like this on the S&P 500.
I'm crying.
Let's whip through the price action briefly.
34,562 on the Dow.
Unchanged on the S&P. Big back-to-back monthly gains on the S&P 500.
Dow green on the screen.
October. Is this going to be our domestic?
That's our domestic today.
The S&P up more than 5% in November. In October, up about 8%. And Chairman Powell triggering this one, TK, in a big way.
Yeah, and I don't know what to make of it. I thought Ben Emmons had the smartest note out last night, which is he had three parts of the Powell tone. And John, seriously, you mentioned this that earlier, and that, as Hollenor said, okay, what changed? And the answer is, I'm sorry, it was hawkish in a cumulative kind of process to 50 beeps in December. So what did the market hear that I didn't hear from Powell?
There was a shift in the emphasis. And it's also what he didn't say. He didn't lean against the easing of financial conditions, and I think that is really important.
Yeah.
I'd also say he emphasized that he didn't want to over-tighten after implying that on the balance of risk, they were thinking that the biggest risk was doing too little, not doing too much. So, Tom, for me, there was a shift there. It was a subtle one and somewhat bizarre as well compared to the performance we saw in the conference, the news conference of a month or so ago.
My shift is, where is economic growth? And I would suggest everybody, whatever their opinion is, it's surprised in the last 6 months to be more buoyant on a real basis and on a nominal basis than anybody expected. And maybe for the first quarter that continues and the recession stays out there somewhere.
I think one thing we can all agree on, Lisa, is that the data is in the driving seat over the next month or so.
And how much is it the actual data versus the soft data? A viewer was listening to what we were talking about earlier about Jay Powell and talking about how many companies do you know that are actually hiring aggressively or hiring as aggressively as they were 6 months ago? So perhaps we're not going to necessarily get the read-through from the jobless claims that we get at 8:30 a.m. or the personal income consumption and the PCE deflator that we also get at the same time. I am watching that inflation metric, since it is one that the Fed looks at, and it has actually climbed in recent weeks. How much is that going to be the theme, this idea that even if you see the overall top line roll over in the face of energy coming down, the core continues to stay strong and prices continue to go up? Today, we have the reality television show that is Fed members, including Dallas Fed President Lori Logan, Fed Governor Michelle Bowman, Minneapolis Fed President Neil Kashkari, and Fed Vice Chair for Supervision Michael Barr. And today, we also get some word from Washington, D.C. with Emmanuel Macron, the French president, coming to join the White House for the first state dinner in more than 3 years tonight. Last night, he dined with President Biden. John, you were really important. You made a really important point earlier where you said perhaps it's more important to look at, John, what we're seeing with respect to France and the U.S. and the alliance with their approach to China than anything else than China versus the U.S., because that might really indicate the contours of the new transatlantic relationship.
Yeah, just in the state of play between China and the United States is pretty well understood. This new tension around the Inflation Reduction Act and the potential for state aid and the pushback we're seeing from the Europeans, Tom, less understood, I would say, and that's a point of tension over the last month.
It's a point of tension, and you go back to the Australian submarine flap and that. But, you know, I looked at the tourist statistics here and the linkage of these two nations just on travel, tourism, the intermingling of the culture.
And a history of it, too.
Stunning. Stunning.
Let's get to Seb Page.
Yeah.
Let's do that right
You
now.
do that right
CIO
now.
and head of global multi-asset at T. Rowe Price. Seb, in your notes, you say you're selectively contrarian. Can you tell me what that means?
You know, we're still careful at the top level. We're still underweight stocks. I don't think we've reached a buy risk moment, but I do see opportunities to lean in selectively. Small caps, high yield, value stocks as part of a diversified approach. We look ahead 12 to 18 months, and those are the asset classes where we see the valuations have reached an extreme where the recession is basically priced in, and kind of like a deep recession, Jonathan.
Seb Page, your book, Beyond Diversification, folks, I can't say enough about Beyond Diversification as an intelligent discussion of too much or too little in your portfolio. I love what you say about Kool-Aid. What's the Kool-Aid of next year look like? I mean, we're all going to drink the Kool-Aid. We're all going to get on a theme. What's a Kool-Aid we need to avoid next year?
I think right now the Kool-Aid is the gloom and doom. We can call it the Lisa Kool-Aid, but that's the consensus.
There we go.
Thanks, Sebastian.
Things are not, or the Tang, Tom, but, you know, things are not looking good right now. You know, you have high stocks valuations, optimistic earnings expectations, sticky inflation, rising recession risks. We're all talking about 3 potential stages to this bear market: the rate shock, which has been priced in, the growth shock, and we're all worried about earnings. And I'm worried about a potential third stage that could unfold next year, which would be a liquidity shock. So that's the Kool-Aid that we're all drinking. I think beyond that, you've been talking on this show nominal growth and the importance of nominal growth and the resilience of earnings. And Tom, you were just talking about even not only inflation stickiness, but growth stickiness. So I think you don't want to drink the Kool-Aid in the sense that you want to go all in cash and give up on diversification because you've just had a co-drawdown between stocks and bonds. I think you go back to a diversified approach and, again, selectively contrarian. I mean, think about small caps. No one really likes that asset class when you're heading into a recession, right? I like the S&P 600. I know you have debates about the Dow versus, I have debates about the S&P 600 versus the Russell 2. The S&P 600 excludes non-earners. Well, that asset class is basically rock bottom valuation of its 20-year range. It's in like the 13 price earnings ratio.
Yeah.
It's basically, the price earnings ratio looks like 2008. So that's an opportunity for me.
Sebastian, I'm just so busy over here just drinking my really depressing Kool-Aid that I couldn't really wrap my head around the positive things that you said, and I keep focusing on the liquidity shock potential. So where do you see a potential liquidity shock?
So it's all about the rate of change, because if you step back, the liquidity level is still quite high, right? We talk about accumulated savings and so on. Where I get worried is this slow boiling frog problem. You know, you put a frog in water and you crank the temperature up, all of a sudden, like, the frog dies and it just doesn't see it coming. I'm looking at the Bloomberg index of liquidity in the treasuries markets, and it's just cranking up and up and up and up in terms of illiquidity, and it's getting less and less and less liquid. And maybe that's QE, that's the change in liquidity conditions, but that is almost level at a level similar to where it went during COVID. And you know, you saw what happened with the gilts market in the UK. You don't really know where a liquidity shock can come in. The swap spreads are showing illiquidity, and you have other measures like underrun, off the run, they're showing lower liquidity. This is a risk you don't, you know, just keeps brewing in the background, and it could be the third stage. It would make monetary policy really complicated, because the Fed would have to do something to fix the plumbing if the plumbing starts to fail like it did during COVID. So, that's why it's not the time to be all in risk assets. Just, again, I go back to diversification.
Well, Seb, let me pick up on that theme. You're describing the pan of water. Tell me how I avoid being the frog. You mentioned equities. What about being in treasuries?
We have a cash buffer in our portfolios. We've been short treasuries all year long, and that's kind of been the trade. And now if you listen to surveillance every day like I do, everybody's kind of now going long treasuries, and we're neutral treasuries right now. So we just take away from stocks, have a cash buffer, and guess what, Jonathan? What is the best time in capital markets history? What have been the best times to buy risk assets, especially credit? It's been during liquidity crises. So as long as you have your cash buffer, everybody's excited about the 4 or 5% return you get on cash. That's nice. One of the reasons why we have that cash buffer is just because there's liquidity risk out there. You don't really know where it could come in, but it could create a massive opportunity to deploy that cash quickly. And those are historically just really good times to lean in.
And sometimes those windows don't stay open very long, Tom. We saw that in spring 2020, didn't we?
Yeah, and the answer here is they move, and they move fast, and you wonder if that's what we're seeing right now. I mean, even the bulls that we talked to, yeah, there's some confirmed bulls out there, John Stolfus and Sebastian and others, but you don't know when you're coming off the bottom. It takes months to figure out, oh, it's a bull market.
Hindsight's a beautiful thing, isn't it?
Yeah, you just don't know it when it's happening.
Sebastian Page at T. Rowe Price, thank you. Also, love the notes from Seb. Do you see that line? Just to prepare us for the interview. I care even less about the World Cup than Lisa.
I'm starting to care.
That in the notes. Basically, don't you dare ask me, Ferro.
Exactly.
Don't you dare.
Please,
And
I'm not
TK,
gonna
don't
do
go there either. Futures unchanged on the S&P, live from New York City. Heard on radio, seen on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell is signaling the central bank will back off its aggressive pace of raising interest rates this month. In a Wednesday speech, Powell also made the case for lowering inflation without sending the economy into a deep recession. Fed policymakers met for 2 days starting December 13th. The missing billions from the collapse of FTX are still a mystery. The disgraced founder of the crypto exchange, Sam Bankman-Fried, denied he was behind a fraud. Still, he told the New York Times Deal Book Summit he made a lot of mistakes. It was his first major public appearance since FTX imploded November 11th. 3 years since the world's first documented coronavirus patient in China, the country is finally pivoting it away from efforts to quash the pandemic. China's COVID czar says the fight has entered a new phase, and the government is making some concessions, such as allowing some low-risk patients to isolate at home instead of in controversial quarantine camps. In South Africa, President Cyril Ramaphosa is considering resigning over an advisory panel's report that he may have violated the Constitution. Bloomberg's learned that Ramaphosa is in meetings with allies looking for advice. The controversy has to do with a robbery at the president's game farm. And a standoff between Twitter and Apple appears to be easing. Elon Musk met with CEO Tim Cook at Apple's headquarters. Afterwards, Musk said Cook told him Apple had never considered removing Twitter from its App Store. Musk began criticizing Apple after the iPhone maker reduced its advertising spending on Twitter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. All eyes are on the jobs report.
Jobs report Friday is going to be huge.
It's the final stretch of 2022.
Is there actually going to be some change in the tone?
Wage data might be more important than the CPI.
This Friday, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is stronger than people have thought it would be.
The recession is not here yet, but the check is certainly in the mail.
We're going into a downturn at full employment.
The November Jobs Report, Friday on Bloomberg Television and Radio.
For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March.
They've done a lot in about 8 months. That was Jay Powell, the Federal Reserve Chair. The next stop for this big debate is going to be a little bit later this week. It's tomorrow morning. It's Payrolls Friday, just around the corner. Equities look like this on the S&P 500, trying to add to the gains of the month of November. Big gains too, up around about 5% on the S&P. We're just about negative on futures now, down by 0.06%. Yields lower by a couple of basis points, adding to the move lower through November of more than 40 basis points on a 10-year, Tom. Your 10-year yield right now, 358.70.
December 1, we dashed to New Year's Eve. Are we going to see an SPX, Standard & Poor's 500, negative 11% right now? Go green?
If you can tell me what CPI will be, where payrolls will
I agree. CPI is more important.
Then I might be able to give you a better guess.
I agree. I agree. CPI is really critical there as well. I noticed the VIX did not move yesterday. A 19 print in the VIX would be a big deal. We're not there. 20.82 on the SPX volatility. Right now in Washington, Anne-Marie Horton joins us, Bloomberg Washington correspondent. Anne-Marie, Valliere this morning, Greg Valliere with a real sharp note on the shock. Congress wants to spend more than the president on defense. We're getting out very $1 trillion-y on defense, but what I love is the international feel here. United States, these are squishy numbers, folks, don't quote me. $850 billion is the estimate. The next one is China, it's sort of $250 billion. Russia, $160 billion as well. Is the Pentagon the defense of the free world? I mean, are we so dominant that the defense budget that we talk about in Washington is a defense budget of, let's call it, the free world?
Yeah, it's massive, and it eclipses all of our allies and our and United States adversaries. I mean, and it has been this way for years. What is stunning about the reporting that Bloomberg government has is that this would be $45 billion more than the president's even asking. So you're getting 11 naval ships instead of 8 that the Pentagon actually asked. And we don't know, there's still negotiations happening, but potentially this Friday, we actually will see it, and we will get more details on what's in that. We do know that the president is asking for upwards of $38 billion going to Ukraine. Potentially that could be a sticking point with some Republicans in the new Congress that really just want some more oversight on that money. Yeah. And then, of course, there's also, we're reporting $10 billion more for defense directly to Taiwan. So you're looking at potentially more ships in the South China Sea.
Is there any talk when you're at the restaurant that Mr. Macron was at with the president last night? You're sitting around having $40 martinis. Is there any talk about a military industrial complex?
Well, Tom, I think what you're looking at now is just the defense spending with the Pentagon is shoring up like what the U.S. has in terms of their defense in the United States and all their military bases around the world, which is why you would likely see this welcomed by individuals like President Macron, individuals like Australia's leader, obviously Japan, South Korea, Germany, etc.
Anne-Marie, as we focus on the international, the domestic very much at the forefront with the number of bills that have to get passed, having to do with taxes, et cetera. Little talked about this morning was the fact that Janet Yellen removed her talk about what she thought about Twitter and some kind of CFIUS review of Elon Musk's taking over, even as we see a real crackdown over in Europe. What's the latest on that? Is there some sort of investigation in progress that we're aware of?
There's no investigation at this moment, though CFIUS is potentially looking into it. But this is something that Janet Yellen, this remark was really walking back an interview she gave at CBS at the G20 in Bali, where she said she didn't understand the president's comments on what they would need to be looking at in terms of Twitter and the foreign money they had when Elon Musk took over the company. She said that but she misspoke, and potentially CFIUS would need to look into this. So it's kind of a murky situation right now, because you do have the Treasury Secretary backpedaling, but is that also because she wanted to make sure she was in line with her boss, the president?
Well, and I wonder how much this is an international concern as well, especially with Emmanuel Macron currently in Washington, D.C., and you see the European regulators cracking down. How important is it from a U.S. standpoint to play ball with them from any kind of review that can be done domestically?
I think it is important. I mean, the Europeans are really out front when it comes to this. Just this morning, I was looking at a ban they want on Russian propagandists. You're looking at the way they potentially want to fire people. That's not how it happens in Europe. So you see Elon Musk having a lot of issues with European regulators. Potentially, the United States is maybe on a slower track, but that's the direction of travel. CFIUS potentially may have to look at this with a harder look. And you're also hearing calls from Congress for them to do that.
AMH, good to catch up with you. As always, Anne-Marie, down in D.C. on the latest. This spat between Elon Musk and pretty much everyone. Apparently the spat between Elon Musk and Apple, the potential spat, that's been dealt with, right?
There was a video after he
met with Tim Cook.
And now he's saying that it was never discussed, that there was going to be some sort of removal from the App Store. Kumbaya. I wonder what happened behind closed doors if he basically was told, look, you keep it up, we're going to pull all of our advertising spending, and that's it.
Tom, you love this story, don't you?
I'm not really following it. I will say this, there's more garbage in my Twitter feed. That is
spam.
A fact. Spam.
I'm getting a lot of crypto spam as well.
Yeah, I'm getting a lot of spam. That's new about 2 weeks ago.
Still waiting to see what he's going to do with the platform. It's his platform now. We'll see what he does with it.
I'm just going to can you get the surveillance cork and put it?
Well, what are you about to say that you're worried about?
You're trying to get him into trouble?
No, I'm just intrigued.
It's sort of like Sam Bankman. What's this? Sam Bankman.
I mean, that's a different issue.
Yeah, but
that's a different issue.
It's this enthusiasm we have for real or not real billionaires. I mean, I don't know. It's been a long week.
Okay, can I actually
They were
disagree.
applauding
I think
this
that
guy yesterday?
Okay, but aside from SBF, just with the Elon Musk and the Twitter, there is a real discussion over what free speech means. And there is a huge divide over that. And he's trying to cater to one view of free speech. And European regulators are saying absolutely not. I mean, his removal of some of the guardrails around misinformation around COVID recently, his removal around some of the people who are supposed to police, child pornography and all sorts of things that are absolutely horrific. How do you then dovetail that into some sort of policy? I think is going to be an interesting question.
I'm pleased you brought up that round of applause yesterday with SBF.
Oh, don't get me going.
Utterly ridiculous.
Don't get me going.
And there's two ways of looking at that story. One is this billionaire that lost all his money. Great. The other is someone who potentially committed fraud. And I think a lot of people are uncomfortable with the treatment being around the former and perhaps not so much of the latter. And this bizarre, I had a bad month, ha, ha, ha.
I stood in a bar on First Avenue the night of the Madoff scandal broke with a woman whose parents lost everything with that guy.
Can you imagine Madoff at a conference?
All this talk about people, all these
fancy
fancy people in crypto, what about the zillions of people that have broken even or lost money?
Lost life savings.
The lecture is over.
the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Coming off the back of the biggest one-day rally on the S&P 500 and the Nasdaq since November 10th. You'll remember November 10th because that was the CPI report, and we had a monster move that day. November delivering gains of about 5% on the S&P 500. Futures this December morning down not even 0.1% on the Nasdaq 100. We're down by 0.11 percentage point. Outside of that, in the bond market, yields lower through November by more than 40 basis points. You can add 2 more to that. We're down about 2 basis points on a 10-year this morning to 358.88 on a 2-year, basically unchanged at 431.81. A theme of November, deep curve inversion. We'll pick up on that in just a moment. A theme of November also, a weaker dollar, much weaker dollar through last month. The DXY, Tom, you can pick out the Bloomberg dollar index if you like as well. Biggest monthly loss going back to 2010.
For a lot of people, John, the dollar is underplayed by the equity market shock. People are sort of reeling from, I guess, another bull market off the June rally as well. And there's people talking about going through 200-day moving average. I'm not a big believer in that. But in the dollar, there's becoming some technical veracity that wasn't there 2 or 3 weeks ago. It wasn't there at the beginning of November where you say, is this a trend towards weaker dollar? That discussion is a December discussion.
You know what happens when everyone's on the wrong side of the boat, Tom, and people start running to the other side? Very quickly,
always
things
happens.
Shake up. We saw that in foreign
Quickly
exchange
is
in
the
a monster
operative
way.
word there.
Jordan Rochester of Nomura, of course, somewhat offside with some of his calls as well. We're going to catch up with him, Lisa, a little bit later this morning.
And how much do people get caught off sides when all of a sudden you start to see natural gas prices ticking up in Europe, which you have over the past couple of trading sessions, and a little bit more colder weather? We can discuss that as well with Jordan Rochester. Just want to give you a couple names that I'm looking at this morning. Software shares. People were trying to hide out in software companies, saying that a lot of big businesses were going to continue investing. They are not as much as people had expected. You're seeing that in Snowflake and Salesforce, with both reporting worse than expected expectations. I find that really interesting because this had been one area that people thought was a lesser bad than perhaps some of the other big tech names. Snowflake shares down nearly 6%, Salesforce down 7.4%. You almost named your dog there, Snowflake. I think that you would have a good, Snowflake. So Credit Suisse shares also, we were talking about that earlier, down today in pre-market trading by more than 6% after 13 straight days of losing, the longest streak ever. Those shares are down more than 66% so far.
Wasn't Snowy Tintin's dog? Do you remember that cartoon, Tintin? Did you ever watch that?
That's a European thing.
Was that a Euro thing?
It was a Euro
Was that, you didn't get into that?
No, I didn't get it.
Okay, all right. Move on then.
It's like, that's it. Is that the stock report
That's
here?
it. We're done.
We're done?
Do you want me to keep going?
No, it's just 4,100 in stocks. I think this is the story of December 1. The shock, and nobody believes in this.
I was confused by Chairman Powell yesterday. Some people might have liked what they heard in November at the news conference. Some people might have liked what they heard yesterday. For me, it wasn't that consistent. There was this odd, subtle shift. And I always think as a central banker, your power lies within what you choose to emphasize. What he chose to emphasize in the news conference in November was this asymmetric risk And the idea is pretty clear because you see it in the minutes. This risk that the risk of doing too little outweighs the risk of doing too much. He also said in the news conference that if they do over-tighten, they can correct that by cutting interest rates. Then yesterday, he emphasises the need not to over-tighten. I'm just wondering where all that comes from.
I'll tell you where it comes from. He's reading Marco.
You think he's reading Marco Klanovich at JP Morgan and thinking what?
I think everybody's heads are tumbling in all this stuff, and they're what they're done. They're ex post. They're after the fact.
Tom, when I notice a shift, something's gone wrong with the communication of this Fed chair at some point between November and I can't work out whether the mistake was yesterday or the mistake was November. You know, to lean that aggressively against easing financial conditions in the news conference and then not even go there at all yesterday is slightly bizarre. I know there's always a risk of over-reading, reading too much into this, but I found yesterday weird.
John, I'm glad over at Good Morning America, they've got the zeitgeist on Farrow, Abramowitz, and Keene. They're saying here, the headline is Bankman-Fried says Madoff comparisons aren't accurate. And I think he's got a point there. These are two different kinds of events we're talking about. We were talking about Mr. Madoff's scandal 10 minutes ago, and to be clear, I agree with Bankman-Fried. They're not comparative, but the shock and the social shock maybe is.
We'll let the lawyers decide that.
Yeah.
We'll let the judge decide that if this ever goes to court.
We're not going to decide it.
I'm not going to have any.
Why isn't he coming on Bankman-Fried? Come on with us. I mean,
no, my issue is exactly that. This is a really serious story. I think the approach by the media, and this has nothing to do with the potential case, but the approach by the media, I think has trivialized something really, really serious. And to your point, this obsession with wealth, that someone's gone from $1 billion to 100K and that's the story. That's not the story. The story is that someone's lost their life savings on some of these platforms, and we've got to work out what went wrong.
The only thing we know for certain is Bradley Rogoff wants to say so far from this conversation.
Without a doubt, and he will.
And he's here. Bradley Rogoff is head of FICC research at Barclays, and they launched their important report today. And we do it, and I love Bradley. Thank you so much for joining us. I love what you've got in there about the humility Barclays has about 2022. And you talk about you need a good defense next year. No one breathing is weather the bond reality of this year. How do you recalibrate into next year with a 10% plus loss?
Yeah, obviously it's not what anyone wanted in terms of returns this year, but now you look today, yields are pretty good, right? And it doesn't mean you're going to get 10% plus returns, but the prospect for at least mid-single digit returns, and in some upside cases or in certain markets, even into high single digits, that exists. And it's the first time where it feels like, okay, just based on the yields coming into the year, we don't need a miracle for that to happen. Now, I don't think it's going to be a straight path between here and there, but I think there's a real possibility for that.
So to go ancient, is this a year forward where we're going to clip the coupon, make the yield, or can you say it is a total return 2023?
I think that, clip the coupon, everyone likes to make that projection at the beginning of a year. If you look historically and how often that actually happens, it is quite rare, right? There's usually some kind of vol event. So what I think most likely happens is it's a year where it's not about rates, right? There's some movement, of course, in rates, but nothing like what we saw in 2022. And instead, what happens is we see some spread weakness probably earlier in the year, if the base case of a recession materializes, and then we get really good returns as we get into the back half of the year, and you can start to see some spread compression, back down towards more normal levels.
Do we just avoid a default cycle akin to what we've seen traditionally?
So I don't think we avoid a default cycle, but akin to what we see traditionally. I'll take that second part of what you just said. I think that might be the case. And one of the reasons that's the case, just for the viewers, you'd be thinking about like 10% high yield defaults as a normal recession period default cycle. I think the number probably could be like half of that. And the reason, and a big part of the reason why, is because of 2020. 2020 wasn't very long ago, and a lot of the worst stuff in the market was cleansed out in 2020 with defaults.
This is the irony of this moment. So many people said for the past decade, there is no way that rates could go above 3% just because of how much debt was in the economy, just because of all of the debt piled on companies' balance sheets. And here we are, and rates are climbing toward that 5% level, and people are saying it's not a big deal because there aren't maturities coming due. When does it become a big deal? When does the refinancing cycle matter?
Yeah, I think you'd have to really say at least 3 years from now. I mean, the amount of debt coming due in the next 2 years, and it differs by different markets, but it's going to be less than a quarter of debt for almost every market. If you think about it, investment grade companies, especially, one of the big stories, and one of the reasons we had all the losses that we just talked about last year, the duration of that market went up a ton, meaning they issued a lot of 30-year type bonds. And as a result of that, there's less coming due in the near term. And even high yield, those companies are prudent. They don't want debt coming due in the next 2 years because they don't know when they might not be able to refinance. The one exception, I will say, is, look, there's floating rate debt. And that's the case in the leveraged loan market, and it's going to hit home there a little bit earlier than other markets.
A lot of people, because they couldn't get that yield, they couldn't depend on any kind of massive return, went to private markets over the past couple of years and frankly over the past decade. That hasn't been fully repriced. A lot of people have talked about the pain that is yet to be experienced in that area. When it does reprice, how much of a bleed through could there be in public credit?
Yeah, I think it takes time also because the only way it really reprices is kind of a default cycle, right? If it's a non-mark-to-market instrument. The other thing you would say is, okay, well, what if there's built-in leverage there, right? And so, for example, something like a BDC does have built-in leverage. They have the ability to put a turn of leverage on those facilities. However, it's a turn, right? And so you're not going to see enough price action, I think, for that to really be the case in 2023. I think the more of the story is those flows that you just mentioned that have been going into private credit, I think those slow substantially. And we're already seeing a little bit of that. And part of it is also that if all of your other investments are down 15% and that one's not been marked down, now everyone looks like they're overweight private credit. And whether you like it or not, you probably don't want to get more overweight.
Brad, got to squeeze this in. What did you make of Chairman Powell?
Yeah, I just heard what you made of him. I agree mostly with what you said, but I think part of the reason he came off that way is they are trying to stay a little bit true to the data dependence. And we got another number tomorrow, right? We're going to have, obviously CPI numbers coming up this month. I forget if it was December already. And
next week.
Yeah, and look, I think we all expected it was going to be 50 basis points in December, and we got that. And then I don't know that they know what it's going to be early next year.
Do you think the reluctance to lean against easing financial conditions yesterday is making their job harder?
Maybe a little bit, because I agree with what you were saying earlier in terms of consistency of message, right? And then only kind of change that message when you have conviction in it, right? But I think you saw someone who actually wants to see if inflation's coming down, because we had a print that said yes, but it was one, and we had one this summer that said yes, and then we didn't have them.
And just to be precise, December 13th, so we're 2 weeks away, there and thereabouts from the next CPI print, Tom.
I think it's bigger.
Just around the corner.
Jobs day tomorrow is a big deal, but the CPI numbers.
He put emphasis on the labour market as well, and wages in a much, much bigger way. Another reason yesterday was bizarre is that he said in the news conference that there wasn't space for nuance around inflation, and then he started chopping up CPI in 7 different ways. It was weird yesterday.
We haven't seen massive dissent on the Fed committee. Is he representing massive dissent and trying to piece it together with perhaps a bit of a muddied message?
Well, yesterday he was meant to be speaking for himself, and at the news conference he was meant to be speaking on behalf of the committee. But I was speaking to people yesterday who were trying to work out whether the news conference was him going off the rails and that yesterday was for the committee. I mean, honestly, I found yesterday really confusing. It didn't make sense, it didn't add up. It was totally inconsistent from the news conference delivery.
We should bring in a psychologist and a meteorologist, and we'll figure it all out.
Well, for therapy for me.
Okay.
Futures, upper 10th on the S&P.
That's what we need. We need joint therapy.
Would you like to come to couples therapy?
Couples therapy?
I think we should do that, Tom.
Dr.
Bramo's going to skip that meeting.
I'm going to go watch the World Cup.
We are so vulnerable.
Jordan Rochester of Nomura coming right up. Brad, thank you. It's good to see you.
Brad, thank you.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is set to slow the pace of raising interest rates this month. In his speech on Wednesday, Fed Chair Jerome Powell signaled the unprecedented run of 475 basis point hikes could come to an end at December's policymakers meeting. He also made a case for achieving lower inflation without sending the country into a deep recession. Well, it's now up to the Senate to avert a crippling U.S. freight rail strike. The House has passed legislation that would impose a labor agreement hammered out by rail companies, unions, and the Biden administration. 4 of 12 unions have rejected the deal. The Senate could vote on the House legislation this week. One of the European Union's top officials has warned Elon Musk to keep Russian propaganda off Twitter. EC Vice President Yera Yourova told Bloomberg that failing to take on fake or misleading content online could lead to a very quick abuse of Twitter. It's the latest warning shot over the possible side effects of mass resignations and layoffs at Twitter. And it's one of the biggest casino deals in the U.S. this year. According to the Wall Street Journal, Blackstone has agreed to sell its 49.9% stake in 2 Las Vegas casinos to Vici Properties, which owns a majority stake. Now, the deal values MGM Grand and the Mandalay Bay at $5.5 billion. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The Fed is trying to run a more aggressive policy relative to its
central bank peers, and yet the dollar is going down because there's enthusiasm that, people in Europe won't freeze to death, and that China is maybe reopening, and so that's providing some optimism around the global economy. The dollar's coming down, and guess what? The trade deficit's been narrowing.
Neil Dutta was absolutely brilliant yesterday from RenMac. Got a ton of feedback. Thank you for everyone that listened to that. It's available online on Bloomberg.com and, of course, on the Bloomberg terminal on YouTube as well, Tom. You're very fired up about that.
Fired up about YouTube.
About YouTube.
It's building.
Okay.
We got a killer audience out there.
I want to get to FX briefly. The turnaround we've seen in foreign exchange over the last couple of months. So let's take the pound against the US dollar, known in FX markets as cable. The low of the year, 103.50 intraday. Got to go back to the 26th of September for that. This morning, Tom, high at a session, 122. We've gone from 103.50 intraday to 122 in just a couple of months.
2 cups of coffee.
Brutal. Euro dollar, you can pick up another currency pair. Euro dollar, low of the year, September 28th, 95.36. This morning, the high at a session, 104.64. These are big, big moves.
What we're going to do is dive into this with Jordan Rochester, G10 FX strategist. I'm going to ask one question here on how do you not lose money, and then John's going to pick it up on the currency dynamics he just mentioned. Jordan Rochester, you, like every adult out there, uses a thing like stop losses. You've been enjoying being stopped out of trades right now. Explain to our audience why it's amateur hour if you don't have stops.
Well, I don't enjoy being stopped out, Tom, but they're absolutely essential to your risk management. I think with the FTX scandal, I think Alameda bragged that they didn't have stop losses, so that's quite clear. What can happen if you don't? But look, what's happening in the markets, Tom, how to avoid losing money here, is the market's looking at US energy prices. They've cooled off year on year. That leads PPI, producer prices lower. That leads headline inflation with a lag lower. So it's quite hard to see reasons why the Fed would get suddenly more hawkish, especially after Chair Powell's speech last night signaling that slowdown to 50 basis points. So you had a green light from the Fed chair last night to sell the dollar and buy risk appetite. And that's why you've seen the NASDAQ up over 4% yesterday. In FX, Tom, the correlations between foreign exchange and interest rates have really dropped off a cliff. The most predominant factor that's driving everything right now is where global equities are going. So I'm currently long euro dollar. We do have a stop on that around 101, 101.70, but I think that's going to go towards 108. I think that's going to be something that could go towards 110 in the new year because of what's happening in China, because the low energy prices we've seen over recent weeks in Europe as well, helping boost European production. So that risk-on sentiment that you see in equities feeds directly to the dollar. Now, there's that famous Spider-Man meme on Twitter where everyone points at each other, blaming each other. FX guys like myself
surveillance.
say
We call that
equities.
Jordan surveillance.
Surveillance. FX guys say it's equities drying everything. Equity guys say it's FX. Well, the main point I would say is if you think that this risk on can carry on in the S&P 500, it means the dollar is going to continue to weaken into year end.
And you'd play that through the euro. Where does sterling fit in?
Well, we had short sterling Swiss on because we thought we needed some RV to hedge our sort of risk-on position. Sterling Swiss had been less correlated to the equity market than other crosses, but you can't ignore that Swissy is a risk-off hedge. So what's happened is we got stopped out of that short sterling Swiss, not because we had some amazing news out of the UK, but for two reasons. One, everybody agreed with the trade, and that always tells you that everyone's positioned the same way as you. And two, risk on. Sterling always does well when the equity markets rally. It's very rare that it doesn't. Only during Brexit really did we see that change in 2016. So for the likes of sterling, we think that you could climb towards 125 by the end of next year. And in these markets, guys, we're seeing big moves in dollar yen, for example, four big figures in just 24 hours. 125 is not that big of a push to see earlier if we have more good news. But based on what we know right now, it's going to be that slow grind higher.
It's hard for me to see any of this other than a big dollar story and everyone else is coming along and rationalizing it in some way or another. I mean, it was pretty much all of the major currency pairs were really big gainers in the past month versus the dollar. And are people getting ahead of themselves with this idea of fading inflation and a Fed that's going to somehow respond to that? I mean, could this really whipsaw in the other direction based on positioning?
I think it really could, Lisa, but not now. That's the problem with markets. We could have a view about what could happen in Q2 or Q3 next year, but the markets don't trade that just yet sometimes. And I think the risks are, for all my leading indicators for inflation in the US, they all point down. There's none of them pointing up. I can't really say, oh my God, watch out for this inflation risk. Look at this chart. They're all pointing to lower energy prices, lower inflation. Therefore, you can say CPI has peaked, and it's quite clearly peaked. We're looking for 0.3% on the core again, month on month. Nomura was the only team, the economics team in the US, to get that number right last month. So if they get that right again, and we have another 0.3 or even lower, it's kind of hard for the dollar to rally. But let's look to next year. We could have in Q2, China's reopened. Q3, we start to feel the impacts of that in energy markets, and the Fed doesn't cut rates, perhaps. That's the risk. We think they will, but the risks are we have a wave of energy inflation again next year in Q3 as energy markets tighten up and demand comes back. And that could change the narrative quite a lot. So right here, right now, I don't think we're getting ahead of ourselves. I think the dollar can continue to weaken against the euro at least. And that should feed through to risk on in other G10 crosses.
Jordan, one reason why I love reading your reports is because you've got this confidence metric, and you have, 3 out of 5, 5 out of 5. I remember back when you were 5 out of 5. Now you're 3 out of 5. How much are you seeing a lack of conviction or a pulling back or a humility in some of the positioning that you're seeing across FX as you sort of sort out all of these uncertainties that are lying ahead?
Well, I think there's a lot of uncertainty. What we tend to have in this market is prices moving, make narratives. Narratives then drive research pieces. But fundamentals ultimately drive where prices will be. Right now, the fundamentals are that we could perhaps see softer inflation, therefore weaker dollar. But we're getting to year end, and a lot of accounts were sat long dollar for most of this year, including ourselves since February pretty much of the year when Russia invaded Ukraine. Why wouldn't you be long the dollar? So that trade is still being unwound in certain sectors. And that means perhaps everything we're seeing right now is just position reduction and no one really changing their optimism for next year. For us, we think there's going to be recession risks. Usually when there's a recession, the dollar does well. The problem is we're starting to see signs of early rebounds in European PMIs, for example. China's credit impulse is going up. So there are fundamental reasons why you could see this risk on be sustained. You just need hope to prevail. And we do have risks coming up. We've got OPEC next week. We've got the EU oil sanctions on Monday as well. That's 21% of the EU's oil imports from Russia being sanctioned from Monday onwards. I'm not sure where they're going to get that 21% of their total oil imports from in the next month. So there are certainly risks to this outlook.
Jordan, you've got 20 seconds. What are you more confident about, your euro-dollar call or England getting past Senegal later this weekend?
I'm pretty confident about the England team. I mean, we've had the USA game was a bit boring. It was like watching paint dry. But what a fantastic Wales game, and hopefully they bring that back to the pitch.
Should Jack Grealish be playing more?
You're asking a Birmingham boy whether Jack Grealish should be playing more. I already know what Jordan's going to say. The answer is yes.
I'm happy with him playing every game, at least in the second half. He gets a showing. He got one of the goals as well in the first game of the World Cup. So this is fantastic for Birmingham. And it's not just Grealish now. We've got Jude Bellingham too.
Grealish is on the edge of Gareth. I mean, he gets in the field and things happen.
He's great.
Did I do okay?
He's
there?
a really classy player.
I spent all night studying for this from Jordan Rochester and you on World Cup. I mean,
we're breaking it down
all-nighters.
City to city, where these players come from, Tom. You're going to another level. Another level. Jordan Rochester, thank you.
I'm just doing it because of our love.
It's so deep.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
You can't really afford to ignore the Fed's speak.
Certainly the Fed is still on this path to raise rates. They've made it clear they are not done.
We believe that they're going to hike and stay at those levels for an extended period of time.
They are going to keep rates tight, and that's going to keep pressure on earnings.
We're probably in for a period of below-trend returns in the equity markets.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is December 1. It is time to buy the Christmas tree at the Keene House. Farrow out front on this as well. And the backdrop of November is a bull market no one saw coming. John, what happened yesterday?
Big gains for yesterday and the month of November, up by more than 5% in November. And Chairman Powell shifting the emphasis, Tom, I have to say, moving away from this idea that there's asymmetric risk and the risk of doing too little is the greater the risk than doing too much, and then yesterday all of a sudden he doesn't want to over tighten.
We're going to truncate the 8 o'clock opening here at Global Wall Street. Well, good morning on radio and television. We got Mike Wilson coming up, an important conversation. Lisa, I'm looking at November and where we are, and I'm told always the bond market's out front of the stock market. Did that happen in November?
Yeah, absolutely. Basically, yields down, and then that means stocks up. When does that break down? We keep asking that, but there is this feeling in markets that maybe we are seeing inflation roll over faster than they had previously expected. Neil Duddy yesterday, you talked about Neil. His base case was that it isn't rolling over as quickly and that people are going to get kind of blindsided by the reality early next year.
One more question, John, as we get to this. Are the bears capitulating? Do you see it within the literature? You follow this more heart-headed. Bank of America.
No. What's funny is that the bulls have capitulated. To see Marko Kolanovic of JP Morgan say we can test the lows.
I think Mike Wilson got his first gray hair off that. You saw that Marko.
Well, I do wonder if Mike Wilson gets uncomfortable when JP Morgan starts to agree. But we can talk about that.
We'll talk about that in a moment. But, it's fluid, folks, is what we're saying on December 1. We're making jokes about a Christmas tree, but what a year it's been. And we've got 30 days. And, John, I'm gonna go to this to start the data check. I've got green on the screen. The Dow Jones Industrial Average 12 months trailing is barely positive. No one saw that.
It's had a big move over the last couple of months.
SPX down 11%.
Equal weight S&P as well. It's had a massive rally off the low. Futures right now up by more than 1% on the S&P. Yields a little bit lower, Tom, by a basis point on a 10-year, 3.59 on a 10-year, and more dollar weakness. We saw it in November. The dollar, DXY down 5% last month and weaker again this morning.
Jordan Rochester, class act for talking about how you get out of those trades successfully. It's called a stop loss. He has been the big winner of the last 18 months. Michael Wilson, chief U.S. equity strategist at Morgan Stanley, was out front with acute week-to-week talk about a bear market, and then up in June, down again, and now up again. An important conversation. John, why don't you lead off with Mr. Wilson?
Well, I think we've got to go to Mike's crystal ball. Mike, I think the call of the year wasn't the call at the start of the year. It was that tactical rally, that bullish call you made about a month or so ago. And Mike, we're seeing it play out. And I think we're all wondering whether you think there's much more upside from here.
Thanks, John. Good to see you guys. Hey, look, I mean, we talked about this the last time I was on, the tactical rally. I felt like the move to 4,000 was pretty much in the cards. And then we said, look, we don't know if we're going to get another level to this. If it's going to happen, we're going to need rates to come in further. And that's what's happening now. And it's going to be probably led by, the NASDAQ and also the, stocks that are most heavily shorted as rates come down, the long duration plays. And that's exactly what we saw yesterday. And so we have more confidence that this rally will continue into December. It's not going to be easy. Because I want to make it clear, as we said last time as well, it's still a bear market. These things are tricky, but we have to try and trade these. When you get 15, 20% moves that go against you, you don't want to miss it. And sometimes we get it right, sometimes we don't. This one we did. So we think it can extend here now. We think rates will go lower. We think, Powell's commentary is right in line with what we've been saying, which is that they're going to pause probably in January. The market's getting in front of that. And this is a classic, kind of Fed pause stock market rally.
And then ultimately you think we get beaten around the head with poor earnings as we go into 2023. Now, Mike, I'm going to read you a quote, and it reads as follows. Previous lows in equity markets are likely to be retested as there may be a significant decline in corporate earnings. We're inclined to think that this market decline could happen between now and the end of the first quarter of 2023. Now, if someone gave me that quote, Mike, I'd think it was you. Except it wasn't. It was JP Morgan's Marko Kolanovic yesterday. Now, Mike, you like to be contrarian. You have been through much of this year. I have to say that view now of early 23 earnings risk is almost consensus, Mike. How are you thinking about it as we go into a new year?
Yeah, I mean, look, you could say it for other people too. I mean, we all try to, stand out with something that's, insightful or different. And you're right. I mean, our call this year now has become pretty much consensus. But that's why we flipped in October, quite frankly, is we felt like that call, the fire and ice call, right, Fed tightening into a slowdown, became consensus. Now we see kind of this idea that we're going to make a lower low in the first quarter. I don't think that's quite consensus yet. But I tell you what's not consensus is this tactical rally. Okay, that we watched our competitors. Talked to a lot of clients to try and get a sense for where that sentiment is.
Right.
And I would say this is one of the most hated bear market rallies that I can recall, even more so than this summer. So I think the right setup now is this rally will go further and will probably drag people back into thinking that the bear market is over. And then that will be part of the signal for us to kind of press on the other side again.
Pushing against that, perhaps, Mike, and this goes to Ellen Zentner and maybe Jobs Day tomorrow, is what inflation does, what the economy does. What do your analysts at Morgan Stanley say about the mystery of revenue growth at the top line next year? And if you get better revenue growth because of high nominal GDP, how does that redound upon margins?
Yeah, this has been an ongoing debate we've had with clients since really April. We were out in front on earnings disappointing at some point into 23. But it does contrast with this idea that we live in a nominal world. Nominal GDP is probably going to stay positive next year, even if we have a recession. Ellen's forecast next year is for not a recession, but basically 0% real growth. So it's going to feel like a recession. But to your point, if you get, if inflation is still positive, you can have positive revenue growth. We have that baked into our numbers, Tom. In other words, our base case of $195 next year assumes that we still have positive revenue growth of about 3% due to nominal GDP staying in positive territory. But it all comes down to margins. And this is the part of the story that we think is underappreciated by a lot of investors, which is, inflation is what drove profits higher. And so as inflation comes down next year, as we're forecasting, we have inflation going back towards 2 to 3% by the end of next year. That's actually bad for equities, good for bonds, but bad for equities because it's going to crush margins. And this is the story that we think is, once again, underappreciated. The negative operating leverage that we're seeing in business models as companies scramble for supply 6 to 8 months ago and overhire, that has to be run through the income statement now. And that's going to be what makes the low in the first and second quarter. So I would say where people are maybe catching up on the earnings story, I don't think they're bearish enough in terms of this margin degradation.
Mike, you said that there perhaps could be a trough of 3,000 to 3,200 in the first quarter of next year as we do get that reality check from earnings. Have the recent data with respect to the latest CPI, with respect to some of the other metrics that people are seeing a softening in, and that we're hearing a change in tone from the rhetoric of Jay Powell perhaps yesterday, have you changed that view? Does that seem further away in terms of that bear case scenario?
Well, once again, I mean, the bear case scenario assumes we have probably a modest recession next year. And in that scenario, all that happens is revenue growth goes flat, maybe slightly negative, but that will make the negative operating leverage even worse. And so that's $180 in earnings next year. So with $180 in earnings next year, 3,000 is not really a stretch. So look, we don't have a crystal ball, unfortunately. I wish I did. In terms of what I'm most uncertain about is the timing of this. We thought it could have actually happened in the fourth quarter of this year, meaning these earnings revisions. And that's one of the reasons we flipped positive in October is we felt like it's going to be pushed out. And that's what's happening. Could it get pushed out further into the middle of next year? Yes. Do we think we can avoid it? No. So we think at a minimum we'll take out 3,500 sometime in the first half of next year. And yes, that bear case, unfortunately, is alive. And that's 3,000.
In the meantime, Mike, let's get one final call from you. What would you buy and hold right now going into year end? What would it be? And it could be away from the index. You tell me.
Yeah, well, I think it's bonds. I mean, I think that if you think about bear markets that are punctuated by either economic or earnings recession, we think we're going to get at least one of those, the earnings recession. The sort of order of operations is very clear. You want to buy you want to be cash first, then you want to buy treasuries, long duration, then you want to buy credit, then you want to buy equities last. So, we're already a lot of people are already overweight cash. So front end cash, or you own back-end treasuries. Now, for a trade, okay, we think it's NASDAQ or, long duration stocks will like that move in rates lower. But that's more speculative. That's for the trading community. I think for the investment community and for asset owners, it's basically bonds.
Mike, just phenomenal. Thanks for your time, and let's catch up before year end. Mike Wilson of Morgan Stanley.
He's
Mike,
on
thank
with
you,
you
sir.
at 9 a.m. tomorrow, I thought.
Hopefully. I think maybe in a couple of weeks' time. There's a great piece. Shanali Bassett did a fantastic interview with Mike Wilson in Bloomberg Markets, this month's edition. So check that out. I think you can check that out online as well. Tom, just phenomenal. Just a great call from Mike and the team. And Mike would be the first to say this is a team effort, a massive team effort at Morgan Stanley.
That's the clinic there and the heritage. And I give Steve Roach all the credit in the world for this. They argue like no other firm. It is part of the culture. You have an opinion, you state it, and you're allowed to publish a different angle. That's the heritage of Morgan Stanley Economics, and it goes right over to their sell-side debate from decades ago, and of course the great work Mike Wilson's done, and that creates a fervor that you don't have at a lot of other firms.
Equity futures this morning, elevated again. Just a little lift here, Tom.
Wilson moved the market.
Up 0.2%.
No question about that.
Equity futures
Marco
up.
didn't.
Yields down a little bit. Now. Down a basis point on a 10-year, 359.80 from New York City. With Tom Keene and Lisa Abramovitz, I'm Jonathan Ferro. Chairman Powell behind us, in front of us. Payrolls data coming up tomorrow morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The missing billions from the collapse of FTX are still a mystery. The disgraced founder of the crypto exchange, Sam Bankman-Fried, denied he was behind a fraud. Still, he told the New York Times Deal Book Summit he made a lot of mistakes. It was his first major public appearance since FTX imploded on November 11th. 3 years since the world's first documented coronavirus patient in China, and the country is finally pivoting away from efforts to quash the pandemic. China's COVID czar says the fight has entered a new phase, and the government is making some concessions, such as allowing some low-risk patients to isolate at home instead of in controversial quarantine camps. Federal Reserve Chair Jerome Powell is signaling the central bank will back off its aggressive pace of raising interest rates this month. In a Wednesday speech, Powell also made the case for lowering inflation without sending the economy into a deep recession. Fed policymakers met for 2 days, starting December 13th. In South Africa, President Cyril Ramaphosa is considering resigning over an advisory panel's report that he may have violated the Constitution. Bloomberg's learned that Ramaphosa is in meetings with allies looking for advice. The controversy has to do with a robbery at the president's game farm. And one of the largest grocery chains in the U.S. has raised its earning forecast for the full year. Kroger also posted third-quarter sales and profit that beat estimates. Meanwhile, the company has put share buybacks on hold while it tries to complete a proposed $24.6 billion takeover of Albertsons. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Can't seem to get enough of Prada. Loafers, nylon bags, and its Miu Miu micro miniskirt have been flying off the shelves into and onto the arms of young consumers. Fashion tech company Lyst placed Prada second on its fashion index at its highest ever ranking. So what could be making this over a century-year-old fashion house appealing to a new generation of consumers?
What Prada has navigated adeptly is their overall kind of understanding of how cultural conversations are happening online, their ability to partner with various cultural figures.
Gen Z faces are at the front of Prada's advertising to this new market. Maya Hawke, Hunter Schafer, and Sydney Sweeney will be familiar to any fans of Stranger Things or Euphoria. There could be another factor at play, the environment. Of those surveyed by The Lancet, over 59% of Gen Z said that they were extremely worried about the climate crisis. So, for example, the revival of Prada's iconic nylon handbag using eco-friendly materials may be winning kudos among these shoppers. Of course, Prada and Miu Miu are not inexpensive brands, and as the global cost of living crisis hits, these brands might start to feel a pinch. But, for now, Gen Z seem to be reaching for their nylon handbags and not letting go.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You used to be the head of the Fed, chairman of the Fed. What goes on in there? And you guys wear robes and sacrifice a goat, and then and right before the goat bursts into flames, it tells you the new interest rate hike that you're supposed to say. What is it? Why is it so secretive?
It was thought once upon a time, I can no longer remember why, but that monetary policy would be most effective if it was most secretive. And the truth is that the Fed never even announced to the public what decision they had made about monetary policy.
The Treasury Secretary and former Fed Chair Janet Yellen sitting down with Stephen Colbert on CBS here in America, Tom. I understand she's also been practicing her signature, ready to sign the currency, and does not want to make this mistake that a certain Jack Lew. Do you remember Jack Lew's signature, Tom, on the currency? Do you remember those squiggles, those round things, whatever they were?
15 zeros.
Was it 15 zeros?
It was
Something like
that.
that.
It was like it could be destroyed.
We got to call Mr. Colbert up. I think on the Fed show he's a value add for
He's going to
us.
bring the rate call. How many goats did they sacrifice before voting for 50 instead of 75?
Maybe those are the questions we should ask.
Maybe.
There as well. What we're going to do right now is we are going to turn to what Nick Fandos over in the New York Times and our wonderful Greg Giroux have looked at is the seismic tilt of Republican success, and that success came in New York. Maybe it was on Long Island, maybe it was above New York City, but the foundation of Republican success for so much of New York starts and ends on Staten Island. Nicole Maliotakis breathed Staten Island. She is one of those rare things, a Greek-Cuban immigrant from a long time ago, her parents, I should say, in the time of Fidel Castro, and she joins us this morning. Nicole, very simple. Thank you so much for joining Bloomberg Surveillance. You guys won on crime. You guys won on a select other issues, a fury of scared suburban voters. What now? What's the next after your victory?
Well, look, we need to continue to push for the policies that we talked about during the election. I'm not going to stop calling on Governor Kathy Hochul to fix the disastrous bail law that has led to crime skyrocketing in New York. I'm not going to stop speaking out against her congestion pricing plan that will just add to the burden of driving into Manhattan for, whether it's employees or visitors or tourists, and I think that would have a detrimental impact to the city of New York. And I'm also going to push for what I said I was going to do, which is to stop the inflationary spending, to focus on securing our border. And that's really what my constituents want, and I think that's what the vast majority of Americans want. I heard them loud and clear when I was at the supermarkets, when I was meeting with them at the senior center or speaking with our veterans. Now we're going to try to push for that now that we have the House of Representatives on the federal level.
Do you sense that this is a polarized constituency of the greater state of New York and frankly of the nation? Or can you find common ground forward with what I'm going to collegially call disaffected Democrats?
Look, I'm a member of the Problem Solvers Caucus here in Congress, where we do try to find some common ground on solutions. I think one of the top things where we should be able to find common ground, quite frankly, within the moderates is energy policy. Look, I'm for clean energy, right? But I'm for diversification, just not to the exclusion of traditional energy sources that we so depend on for manufacturing, for transportation of goods, for food. And that has to be really what we need to do, is unleash America's potential in all aspects. So I think that's one of the ways that we can actually address some of the issues that we're facing with inflationary costs, particularly with energy, and bring down costs for consumers and on manufacturers and small businesses. I think that's one area. I think on border security, this should be common sense. I mean, people should want to see our nation's borders secure in a post-9/11 world. The fact that you have over 100 terrorists who have crossed and tens of thousands of convicted criminals, they should want to address that and the fentanyl that is streaming over, killing Americans.
Congresswoman, a lot of people are questioning the leadership right now of the Republican Party, especially as we start gearing up for the 2024 election run-up. You've expressed support for Donald Trump. Do you continue to support him as the leader of the Republican Party?
Well, look, I don't know if he is the leader, but he certainly is a leader of the party. But I think what's nice about the Republican Party is we actually have a bench for once, right? It's not, just President Donald Trump. We have people like Governor Ron DeSantis. We have other leaders like Nikki Haley and Mike Pompeo. We have leaders that are coming into the House of Representatives that are very reflective of America. We've just elected more African Americans, more Asian Americans, more Hispanic Americans, and more women. So we have a bench right now. And the bottom line is we're going to find the best candidate to run in 2024. And I think it is important that we are united in this process. And look, it's just playing out now. We just finished with the midterms. But we must be united going forward, both as a conference here in the House, so we can push President Biden on the border, on public safety issues, on energy policy and inflation. And that's what we're focused on right now.
Is it important for the Republicans to be united, or to there to be a united, sort of more centrist look at how to make policy? And I ask that because a lot of people took the takeaway from the latest election as a move to the center.
Sure. Look, I think we just have to find that common ground of where the Republicans in our Big Tent party can come together to support the candidate that we think will be able to have the best chance of winning in 2024. But make no mistake about it, if you compare President Trump's economic policies and border security policies and energy policies with that of President Biden, you want to throw in foreign policy as well with the success of Abraham Accords and USMCA, I would say that we were much better off as a nation in terms of policy under President Trump. And so I think we want someone who's going to continue to push for those same policies, whether it be him or somebody else. But I think the bottom line is we needed a balance in Washington, and we were able to achieve that this cycle by getting Republicans. One-party rule has been disastrous for, I think, the country and also for my city and state. So we're just looking forward to, yes, find common ground. I'm willing to work with the Democrats when we can come up with sound policy that's going to address these issues that I mentioned: border security, energy independence, stop the inflationary spending, and let's protect our men and women who serve our nation, both whether it's at the border or in our cities.
Congresswoman, thanks for your time today. We appreciate it. Down in Washington, Nicole Maliotakis there. Weighing in on some of the big issues. I want to keep it on foreign policy just briefly, Tom. Just hearing from the French President Emmanuel Macron speaking to ABC ahead of this big get-together over the next couple of days with the President of the United States. He's saying the Inflation Reduction Act lacks a level playing field, that the so-called IRA has not been properly coordinated with Europe. And Tom, this is something we've been talking about over the last several weeks. There's just a little bit of growing tension here between the Europeans and this administration over this issue.
And you see it on Brexit as well, where it was going to be a Pax Britannica, and they were going to expand out as well. They're running into trade realities, and you see how that goes forward. And one thing I would say, John, is into next year, we have to redefine post-pandemic what the new globalization is and what the new transatlantic is.
Can't avoid this story either, Tom. Macron says that Musk-ending moderation on Twitter is, quote, a big issue. For the Europeans, and I guess that content moderation might become a bigger issue for the Europeans, then, Tom, we're going to have this conversation about whether Twitter will be taken down in Europe, and this will go on and on.
And can he talk about, like, what it costs to fly to Paris? Can we, like...
You want to have that conversation with Macron?
Give us more flights.
Cheaper seats from New York. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income. I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
Seconds away from economic data in America, teeing us up for payrolls coming tomorrow morning. Going into all of that, equity futures at the moment on the S&P 500 through most of this morning, kind of positive or negative by a couple of tenths of 1%. It stays that way this morning. The S&P up 0.2%. That economic data dropping right now. Let's get to Mike McKee for more. Hey, Mike.
Good morning, John. Well, we've got some numbers on initial jobless claims. They're the first ones to fall here, 225,000. They're staying in the same range. It's kind of interesting, and I'll discuss this a little bit more with you on your show later. But Goldman Sachs is suggesting that these are artificially high, that the seasonal adjustment practices adopted by the Labor Department after the pandemic to account for the wide dispersion at that time are pushing up the jobless claims numbers more than they might otherwise be. But this is a big drop, 225, 240, so whether they're distorted or not, it's still good news. Now, the big news of the day, the income and spending numbers, and I'm going to go straight to the inflation part of this, the PCE. This is what the Fed follows, up 0.3 during the month. That's less than the 0.4 that had been anticipated by economists surveyed by Bloomberg, puts the PCE deflator for the year at 6%, down from 6.3% the prior month. The core, which is what everybody's focused on, 0.2 lower than the 0.3 that had been anticipated, and the core for the year is now at 5%. That's down from 5.2%. So the numbers that the Fed follows on inflation are better than anticipated. Income's up 0.7, and I'll look in just a second to see where that money's coming from. Spending up 0.8, and both of those are significantly up from the month before. So at the same time as the economy is strong, inflation coming down a little bit. Now those income numbers may be affected by the inflation numbers. Real personal spending, inflation adjusted, up 0.5. It was 0.3 last month. So Americans are still spending money. but inflation has come down a little bit.
Upside surprises where you want them and downside surprises where you might want them this morning. If you're long this equity market, we have a little kick high here on the S&P, Tom, up by about 0.4% on the S&P 500, a little leg lower on Treasury yields, particularly on the 10-year and beyond. The 10-year down by about 3 basis points to 358 this morning, TK.
Vince Reinhardt here in a moment, but I've got to ask you, Mike, about this. I mean, after what we heard from Powell yesterday, this is really not what he wants, and particularly if we get more accommodative off the Bloomberg Financial Conditions Index.
I guess you could make the other argument, Tom, that it is what the Fed wants because they don't want a recession. And if we're going to see some strength in spending, that's going to be okay in the long run. The question is, does it push up inflation? And if inflation's coming down at the same time that these things are going up, and we'll have to dig into these numbers, that's going to matter. You know, for Jay Powell.
We got to get to Vince, but very quickly here, Liz Ann Saunders out making a big deal about the Challenger numbers. You and I have looked at Challengers over the year and said, maybe it's not there. Is Challenger like ADP, where I don't care, or do you see the Challenger job statistics as a concern?
Challenger is
gray. Challenger gray.
You don't care because they compile for press releases job cut announcements, but those are overseas and in the U.S.
Okay.
And
Challenger exists to make the ADP look good.
It's
Tom.
attrition.
I'm just bringing it up because
firing.
You know they're the numbers. They're pretty grim, and you know that's what we do, folks. We talk to adults like Mike McKee and Vince Reinhardt.
More numbers in about an hour and 27 minutes. Looking forward to getting the ISM a little bit later. Mike McKee's going to break that down, Tom.
The quality of what we do as we celebrate Lisa Abramowitz, John Farrow, and I in Bloomberg Surveillance, what we do every day is our guests, and it starts and ends with the research capabilities of Vincent Reinhardt, assisting chairman Greenspan over many, many years at the Fed and at Dreyfus Mellon, holding court in important writings in the pandemic about the state of our economy. Vince Reinhardt, just a general question of a 2-hour conversation. Do you buy the idea we're heading for recession? In your years with Greenspan, were you able to predict a recession?
Nobody really predicts a recession. What you can say is there's an elevated chance of it, just like you could say you have an elevated chance of infection if you go into bad places without a mask. There is an extremely elevated chance of recession. And if you had to place your money, I bet that within 12 months, the economy is in downturn.
I look at this, Vince, and then I look at the parlor game of the Fed, which is now different than when you were holding court at the Eccles building. And the basic idea here is we're gaming out a rate movement higher, and then we are, quote unquote, going to figure out to pivot and guess when that occurs. Have you ever seen anything like this, or is this new pundit territory?
This is old style monetary policy. Right now, monetary policy is hard but simple. It's hard in the sense they have to inflict pain on the economy to get inflation down. It's simple because the strategy is if you don't know what the right neutral funds rate is, put it at a level you sure is restrictive and then keep it there until you have demonstrable evidence that inflation is going back to goal. So if you're not exactly sure how to calibrate policy, don't. Put it at a plateau next year and just wait. That's what Chair Powell told us yesterday.
Is that what he told us yesterday, Vince? Or did you hear perhaps a little bit more of a concession around perhaps moderating their stance in order to avoid a hard landing?
I don't get how most of the headlines came out of that remarks yesterday afternoon. He repeated his press conference characterization. We're raising rates till we get them to a level, and then we're going to keep them there. He dismissed a lot of data. With regard, I don't want to be on the other side of Mike's argument, but I think I have to be. Yesterday, Chair Powell said inflation moves around sometimes after good numbers, bad numbers come out. So I think that they would downweight the PCE price part of this. And then what he was saying was we've got to keep the pace of aggregate demand below that of trend. So he should be worried about the spending part about it. This was not a good morning for the Fed.
Well, Vincent, this is really the key point. A lot of people are saying that there is a downward shift in inflation, and it's coming at a pace that's surprising analysts, that this is good news. It's going to allow the Fed to move away from some of the rate hikes and even cut rates sooner than previously expected. Do you think people are getting ahead of themselves, that really those inputs are not declining quickly enough, and that they could even re-accelerate based on some of the rollover effects in areas, for example, like used cars?
Events always look bigger in the rear view mirror than they really are. I think there is a tendency to overweight this incoming information. Chair Powell said that yesterday, by the way. He said inflation's volatile. Sometimes after good readings, you get bad readings. He was basically telling us not to be so stressed about it. Do I believe inflation is off its peak? Absolutely. Goods price inflation has come off the boil because supply chains have been improving, and market economies work by bringing resources into sectors that are overheated. But it's spilled over to service inflation. That's what you got to worry about. That's what Powell's worried about. The durable part of inflation that's still above the Fed's goal.
Vincent Reinhardt, Olivier Blanchard reaffirmed a higher level of inflation we can be comfortable with. He went from 4% in the crisis of 08-09 down to something more like a 3% level is the new 2%. Without going into the details of the Blanchard essay in the FT, is he onto something here, which we are going to rationalize our way away from the 2% level?
So yes and no. The yes part is back in the mid-90s when central banks settled on a 2% inflation goal, it's not like they had a great conversation about the costs and benefits of that long-term goal. And we know more about problems with the zero lower bound. And so we should have a serious discussion of what the right goal is. In the United States, it's got to include the Congress, by the way, because it's the Congress that specifies price stability. That's my no part. I wouldn't want to have a conversation with the Congress about the Federal Reserve's goals most times, certainly not in the next 2 years. Moreover, it's one thing to redefine the goal when you're succeeding. It's another thing to redefine the goal when you're failing.
We call that the Bank of England.
That's just base drift. That you just can't do it.
Hey, Vince, well said. Vincent Reinhardt.
That was brilliant.
Wonderful, thank you.
Brilliant.
Of Dreyfus Mellon there. And Vince is right. If you can't get down to 2 and you start talking about 3, Tom, I think you can make the argument it would be equally as difficult to get down to 3 because people have started to question the commitment to that.
Well, that was just brilliant. I mean, Vince is very dry and academic and that, but you look, John,
He'd appreciate that characterization.
No, I mean it. I mean, with this heritage of research on serious stuff on economics.
Alaskos was so
when
dry
he
and
was in
academic.
I think he's
come on,
fabulous.
when he was in research at the Fed, they were on fire. They were writing really wonderful reports. But we've got the idea of the work we've done on surveillance with Blanchard over the years, Adam Posen at Peterson Institute, on to Vince Reinhardt. And then there's Jean Boivin writing yesterday in the FT, and you've got him in the 9 o'clock. I mean, that's
Great
what we're doing here.
Next hour.
I mean, I'm sorry. That's what we're doing.
BlackRock, Seema Shah of Principal. Going to catch up with Chris Harvey of Wells Fargo as well around the opening bell. Mike Wilson was on about 40 minutes ago. If you missed that, this call he had over a month or so ago about this tactical rally you could get, this bear market rally into year end. Well, it continues this morning, Tom, up 0.5% on the S&P 500. The consensus view is that we get smacked around the head by the reality of bad earnings in early 2023. But at the moment, Tom, this equity market keeps climbing.
Yeah, you know, it's just extraordinary all in all. And, you know, I look at the heritage of what we've got in the equity market climbing and that. This reminds me of when Tunisia, they beat France yesterday.
What a
and
game.
when they beat North Macedonia, that was really something.
You had to do that on our anniversary.
I had to do that with the exit out
on our
here.
anniversary. Where's the love?
There's no love.
Taking digs at the Italian football team?
No, I just think that Tunisia, North Macedonia was probably a more competitive
Are we going to do this another 10 years?
They won on penalty shots.
Do you reckon we can go another decade?
I think so. Lisa, what do you think?
I don't know if Brammer could handle us for that long.
I'm just waiting for you guys to work it all out.
No. You let me know how therapy goes.
Thank you for the comments, folks.
Future's positive, 0.5%. Happy anniversary.
Oh, please go away.
I will.
Go away.
To my next show. This is Bloomberg.
Steal our guests.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is set to slow the pace of raising interest rates this month. In a speech on Wednesday, Fed Chair Jerome Powell signaled the unprecedented run of 475 basis point hikes could come to an end at December's policymakers meeting. He also made a case for achieving lower inflation without sending the country into a deep recession. It's now up to the Senate to avert a crippling U.S. freight rail strike. The House has passed legislation that would impose a labor agreement hammered out by rail companies, unions, and the Biden administration. 4 of 12 unions have rejected that deal. The Senate could vote on the House legislation this week. Meanwhile, the UK will be affected by strikes every day this month in the run-up to Christmas. Workers from the country's rail network, buses, postal services, health sector, and schools are among those staging walkouts. Union leaders want to cause maximum disruption in their bid for higher wages. They're concerned about inflation and the government spending cuts. One of the European Union's top officials has warned Elon Musk to keep Russian propaganda off Twitter. EC Vice President Yera Yourova told Bloomberg that failing to take on fake or misleading content online could lead to very quick abuse of Twitter. It's the latest warning shot over the possible side effects of mass resignations and layoffs at Twitter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK. have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Markets are pricing rate cuts, a pretty aggressive rate cut cycle. But in the face of this persistent inflation and supply constraint that I just talked about, we believe that they're going to hike and stay at those levels for an extended period of time.
An incredibly important conversation yesterday in Bloomberg Surveillance stopped with Wei Li, Chief Investment Strategist at BlackRock. Her comments on her China, Lisa, were stunning yesterday.
Especially,
it was like a pin drop in the room, and it's never like that.
Especially at a moment of such incredible calibration, and so many people are getting bullish right now in China going into next year on the prospect of reopening. How do you parse that out? Taking a different view there.
Just thank you to Wei Li for those comments. Just really, really important. Somebody that was there when Mao took over China was Robert Dahl. He's Chief Investment Officer at Crossmark. He's been doing this a few years along with me, and we're thrilled he joins us in the studio this morning. You got a little bit in your note there. For the first time in 50 years, we've been this gloomy. We've had this much gloom out there. And that's why I make the joke back to 1947. But part of that is years in my history is when inflation moves, it moves suddenly to disinflation. Is that where we are right now?
I don't think we're quite there yet, Tom, unless you're going to call acceptable or disinflation 3 or 4%. I think we can get there with what we've done, but not 2, nowhere close to 2.
Okay, well, not to 2, but then we're there, and that means I've got nominal GDP, which helps corporate revenues.
Yes.
Who are the survivors of a better corporate revenue, given an inflation milieu that you and I are the only 2 that have ever lived in?
Given that we want some pricing power, you've got to go to the places where people can raise prices. We haven't been in that environment in a long, long time.
And I'm going to tell Lisa, you're going to love this. I used to go up and down the elevator in Boston with the giant Philip Carre, who Bob and I worshiped, died at, I think, 104. And Mr. Carre would, and it is Mr. Carre, Mr. Carre would talk about the bright lights of inflation. That's where we are now.
So if we're going to talk history, let's talk history. And let's talk a half a century ago, which was the last time that we saw 3 consecutive quarters of stocks and bonds losing value together. What does history say? And is it instructive in terms of what that means going forward?
Well, first of all, the reason it happened was the rapid adjustment. We had essentially 0 inflation and 0 interest rates, not to exaggerate by much. Then all of a sudden the Fed said, oh, it's not transitory, and we got to get moving. And so we've had the most rapid increase in Fed funds. And you guys said it a few minutes ago. The lag is impossible to predict about the impact of that. And so we're going to have a slowing economy, and that will help bring the inflation rate down. The Fed's got to pray that the labor market quiets down.
So one guest after another has talked about flooding into treasuries, flooding into duration. Even Mike Wilson of Morgan Stanley, he comes out, what would you be buying? The equity strategist, bonds, right? I mean, how much do you lean into that versus step away and say maybe people are overestimating how much inflation can drop?
I think, Lisa, that owning some bonds is just fine. It's 0 at the beginning of the year. You didn't want any. When treasuries approach 4 on the 10-year, we say you've got to be nibbling away at bonds, and we're not that far from that now. So the old 60-40 is dead that we all preached a year ago. Not true anymore. Bonds have a place in the portfolio, especially if you believe inflation's coming down to 3 or 4. Forget the 2 for the moment.
My theme for next year, you're the only one breathing who remembers a specially chemical roll-up of years ago. Remember?
He's not that old. Like, what is this? But carry on.
No,
I mean, come on.
Bob and I remember when every wise guy in Manhattan said, we got to roll up the chemical industry. Remember that?
Yes.
We all went mental for 18 months and turned it into 3 companies or whatever. I'm talking about the great zombie roll-up next year where we demarcate between profit-making and cash flow-making companies and everybody else. Do you agree with that there's going to be a demarcation?
So agree. And what that means more broadly is fundamentals matter again. When interest rates are zero, they're artificially low, and you can't really say that the good guy wins from a stock price standpoint. How did Sears last so long? The answer is because they were given artificially low interest rates, and that was tough for places like Target. Now, in this environment, the Targets will do well, and the Searses will struggle.
Explain to people that under duress, corporations adjust. How does that process actually happen?
Yeah, it's slow because they've been so used to zero inflation and
They had a
zero
free
interest
lunch for
rates.
12 years.
Exactly, and got used to operating in that sort of environment. This is a different world now. And we come back to, can you raise your price? Can you attract customers and keep them as your price rises? Look at what's happening in the steel stocks, for example. You mentioned chemicals earlier. But steel are poking their head up. And this is telling us we're in an environment where inflation's not going back to zero. I don't think it's
U.S. Steel is still X. I haven't looked at that in years.
See that chart?
But people are talking about how the real economy is getting its revenge. That has been the theme for 2022, and it's rearing its head, and that's why you're seeing the inflation underpinning some of these commodity sectors. How much does that mean that the other areas that got bid up, I'm thinking big tech in particular, can't really come back in the same kind of way and won't necessarily drive indexes to the same extent?
I think you're onto it. We've obviously seen it this past year, but I think going forward, we're going to have the same sort of issues. If you're a company that's operating only on unit growth, your unit growth is going to be really strong to get you through. And tech is mostly unit growth, so I think they will be a lagging sector again.
What are your clients doing? Well, your Crossmark out of Houston and, nationwide and all that. Are they loaded up their eyeballs in cash? What are they actually doing with their money?
Yeah, so people are asking a lot of questions. Too many people are frozen. But they're making investments. You have to hold their hand and draw them to the horse to the water.
You and
help them
Victoria
drink.
sing "Let It Go."
Yeah, something like
Ellen now.
Yes.
You have an equity market neutral product.
Yes.
Bob Dahl, the great optimist. Thank you so much with Crossmark.
All the best.
Global
Thank you.
Investments here. And Lisa, we've got some optimism. I don't want to oversell the tape here right now, but off the economic data that gets us to jobs tomorrow, McKee lectured me, forget about year over year, Tom, we're moving too fast. You go month over month, and those statistics on PCE deflator are actually pretty good.
Yeah, I don't buy it. I'm going to be honest. I don't buy it. And this is the reason why, because you saw an upside revision to some of the data. So it came down less than expected, but it came to the same levels that people were previously expecting. Right now, you're seeing confirmation bias in markets pretty much uniformly. People are taking this rally and running with it. I keep wondering whether anyone's actually pulling back from the pessimism that starts next year. They're basically just trying to get ahead of it. But this is a timing issue. It's not that people think that the clouds have all abated.
To be fair to you, I'm hearing that as people rationalize this bull market, including what we heard from Mr. Wilson of Morgan Stanley, is that everybody's doing timing. Everybody's trying to figure out, we're going to go up this, and then we're going to go down, and we're like this. And I don't hear anybody like Bob Dahl saying, would you just buy amalgamated copper and hold it? Well, I don't hear that.
A lot of people actually are talking about the commodity sector because it has been underinvested and because of some of these secular trends that are going to boost them. Again, China reopening, colder winter, recession.
What's great about it is on this anniversary of Bloomberg surveillance and all that, Lisa Bramwitz, John Farrow, and Tom Keene, we end strong with Bob Dahl, who actually knows what the Dow Jones Industrial
It's not fair. John isn't here to rebut that. Discuss equal wage.
Thank you for your comments today. Rumor has it we'll be here tomorrow.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Live from New York City this morning. Good morning, good morning. Back-to-back monthly gains on the S&P 500 for the first time this year, and we tried to add some weight to the recent rally. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, we begin with the big issue, a not-so-subtle shift from the Fed chair.
We heard from Powell.
In terms of consistency of message,
Powell couldn't have been more different from Jackson Hole.
He was actually not, in my opinion, as hawkish as he could have been.
When you pull back the information that he talked about, he still said that we still have a lot of work to do.
But the things that the markets took away from it,
They're going to moderate the pace of hikes going forward.
that indication that the days of 75 basis point rate hikes from the Fed may be at an end.
It becomes a little bit of a vicious cycle.
Treasuries rallied, especially at the short end.
Anytime, the Fed sounds even a little bit dovish, then you're going to see this risk-taking.
It's already happening effectively, and it's really just down to the Fed now to manage that transition.
Joining us now to discuss is BlackRock's Jean Bavin and Principal's Seema Shah. Seema, first to you. What's behind that shift, the difference between this Fed chair that we saw yesterday and the one I saw at the last presser?
Yeah, I don't think he said anything substantially new. He repeated the idea that there's going to be a downshift of 50 basis points. I think that was already fully priced into the market. There can't be even one person out there who would have been surprised by that. But maybe the big thing was that coming into the meeting, some people were worried, of course, that he would take a slightly more hawkish perspective, pushing against this slight easing of financial conditions, and he didn't. And of course, he talked a little bit about not wanting to over-tighten. Really, look, the market had what it wanted to hear. We've had this rally in the last couple of weeks. It wanted to hear something dovish, and that's what it heard.
It's what he didn't say, isn't it? He did not lean against easing financial conditions. I think we all found that notable. And John, I was making notes as he was speaking, and I was comparing it to what I heard in the news conference. The shift in emphasis from the Fed chairman in the last 24 hours, from yesterday to the press conference, he's gone from talking up asymmetric risk, the risk of doing too little outweighing the risk of doing too much, higher for longer, a higher terminal rate, maybe a month or so ago. And yesterday he's talking about not over-tightening and highlighting the slower pace to manage that risk. What did you make of that, Jean?
Well, I agree with what was just said in the main, and I think I don't see necessarily a big shift. I see maybe some communication, noise here. I think at the end of the day, when you parse through this, key things he said to me were like one clear sentence at the end was around the fact that what matters is the terminal rate, the level, and how long they're gonna have to stay there, much more than the pace at which now they're gonna be delivering those hikes. And I think that's the key message here. And at the end of the day, taking a step back, their frame is all about inflation. There's nothing about managing trade-offs. So at the end of the day, we can listen to what he says and so on, but it's gonna end up being about inflation. And on that front, I don't see any room to be dovish, any justification to a big shift from the press conference. So I think this is a bit of noise at this stage.
Jean, at the end of August, he talked about causing pain. He said pain was part of the story to reduce inflation, the unfortunate cost of reducing inflation, but a failure to restore price stability would mean even greater pain. That was the speech over in Jackson Hole. That Friday, we closed lower by more than 3% on the S&P to 4,057. Yesterday, we were at 4080. Does it make sense that the S&P is back to where it was basically at Jackson Hole?
No, I think the markets are primed to hold on to any bits of dovish aspect that we see now as a justification for a rally, which we very much see as a bear market rally still at this juncture. And I think what he really whether he mentions the pain that is needed or not, it's going to be needed. So if you insist on bringing inflation down, there's no way around it. So I think our advice is to focus on what's needed to get there, no matter the noise on the way from the Fed that will come.
So, Seema, would you fade this market rally?
Look, I think technicals can take it a little bit further. The market wants to hear the dovishness. They've got the data that they wanted to see. As we heard Neil Dutter talking great interview yesterday, the economy is pretty resilient. So there is this idea that there is maybe a path to a soft landing. Now, beyond the next 3 or 4 months, no, absolutely not. This is not a market that can be sustained. Take a step back. In the last, we've seen the Fed raise rates by almost 400 basis points, and they haven't done that in a process of a couple of years. They've done it in less than 12 months, and yet the market is only down some 15% or so. That doesn't seem enough to me. So take a step back, look at the fundamental picture. There has been a significant tightening in financial conditions, and the economy is still very strong. At some point, those chickens are going to come home to roost, and there will be equity market weakness.
Well, they're not right now. We're adding some weight to the recent rally, up another third of 1% on the S&P 500. Back in the middle of November, John, you and a team at BlackRock said the Fed is still on a path to create a recession via policy over-tightening. Stocks aren't pricing that in. We stay underweight. Have you changed your mind in any way, shape or form, Jean Bavin, in the last couple of months?
Just put out our outlook yesterday, and where we are right now is exactly where we were when the last time you spoke. So I don't see the conditions yet in place to this is a recession foretold. It's going to have to come because that's the only way to bring inflation down, as long as they insist on bringing inflation down to 2%. At the end of the day, we think sometime in 2023, they'll have to back off from this. Maybe markets are seeing some glimpse of that, but we're not there yet. And I think the real story here is, it's ready to monitor, try to see how much damage we'll get at the end of the day, and how much of it they wanna inflict. And once we have greater clarity on this, then we'll see the basis for a more constructive environment. But this is a few months away, certainly, and this is a 2023 story.
Well, the economic data is in the driving seat now. It's payrolls tomorrow morning. Then in a couple of weeks' time, it gets CPI. Yesterday on the S&P 500, the biggest one-day rally going back to the November 10th CPI print. Katie Lyons has more. Hey, Kaylee.
Hey, John. It was a monster rally, and the first thing Mike McKee and I did this morning when we saw each other in the office was ask each other what was that about. And I really think that the conversation you were just having kind of nails it, in that it wasn't necessarily that he didn't say anything new. It was that he didn't say anything newly hawkish, and that seems to be what this market was clinging to. So as a result, you got a big rally in the S&P 500, an even bigger rally in the NASDAQ 100, which was up about 4.5% yesterday. Both of those indexes hitting their highest since mid-September, and the gains are continuing this morning. Interestingly as well, volatility coming down substantially. The VIX index volatility fear gauge is now at a 20 handle, and of course we got the monster rally in the bond market as well. The 10-year yield dropping 14 basis points yesterday yesterday, the 2-year by 16, and not moving quite as much this morning, but it is holding. You aren't seeing a reversal of that. And of course, that front end move in particular, reflecting the move lower in expectations for ultimately what the terminal rate will be. Even though Powell reiterated the message that they may be moving slower, but they could ultimately be moving higher, market pricing went lower in terms of the peak Fed rate, actually indicating that it could potentially be below 5%. And maybe the cooler PCE deflator month-on-month figures we got this morning feed into that narrative. But of course, as you mentioned, John, we're not done with the data yet. We still have the jobs report and CPI before the Fed decision in mid-December. And of course, the expectation for that decision, which the market seems to have gotten solidified by Chairman Powell yesterday, even if he didn't say as much in so many words, is 50 basis points. And then the hike for February being smaller, and March almost seems like a bit of a question mark at this point, because right now, John, only 15 basis points priced in.
Hey, Kaylee, thank you. That's the Fed story. On the horizon, earnings. And overwhelmingly now, the consensus view is, yes, this bear market rally can continue, but ultimately, in the first quarter of next year, we get slapped around the head by reality, and that reality is weaker earnings. Even Marko Kolanovic at JP Morgan on board with this view. This is what he had to say. Previous lows in equity markets are likely to be retested as there may be significant decline in corporate earnings. We are inclined to think that this market decline could happen between now and the end of the first quarter of 2023. Seema Shah, how consensus has that view become?
Well, look, I mean, finally, we're in agreement with Marco on that. I think it's consensus in that the first half of the year is going to see a very, very significant earnings slowdown. I think we pushed back in terms of the timing a little bit. Actually, we think it could be pushed out to Q2, partly because actually our recession forecast, we pushed it a little bit further out, given this very important economic resilience and labour market resilience that we've been seeing today. But certainly, yes, 400, however much it's going to be, we're thinking 500 or so basis points of tightening. At some point, that is going to have an impact on earnings. And that is the time that we're looking for this almost second leg to the equity market downturn.
Jean, are you in agreement with that, just in terms of the timing?
Timing is difficult, but as you know, when we've talked about earlier, our main view was that this earnings recession, this earnings outlook was not in the price. We thought that the rate path was more in the price when we last talked a few weeks ago. Now that disconnect has reappeared, so that on the two front now we're seeing a disconnect between the reality and what markets are currently pricing. I think one feature in terms of the timing that's going to be unusual in this environment is that this recession is foretold. As you say, like, this is becoming consensus, and we haven't really seen it yet. So I think we could see markets pricing it sooner before we actually see it, even the data, and look through it at some point. But that's going to be after some adjustment, some repricing.
Jean, there's one interesting point that I want to make, and it's from your outlook, and it really stands out to me. When I hear from Bank of America, it's buy bonds in the first half. You hear that from Michael Harner. You heard it from Michael this morning from Morgan Stanley, Mike Wilson. And I just wonder from your perspective, Jean, why you don't think the bonds are going to work this time around.
So there's a distinction to make at the outset, which is like, short-dated bonds are pretty attractive. We're getting yields now that are like, instead of staying in cash, you can get a very decent yield, something we haven't seen in a very long time, and there's a very significant lure of bonds in that sense. When it comes to the long-dated bonds and, thinking of the usual playbook of a recession is coming, you want to hide in bonds, that we are skeptical of this. I mean, this is a recession that is foretold. This is a recession that is needed to bring inflation down, and the causality runs the other way. So in this typically in a recession, you see inflation surprising, it comes, and then you can see downside surprise on inflation. Here, the question is how deep the recession will need to be to bring inflation down enough. And that means that the central banks will not be to the rescue here or providing cushion on the downside. And I think in that context, we should expect duration and long-term bonds to play the same kind of badass role they've been playing. So that's not a read-through for us. And in fact, we see other structural trends that will be pushing yields higher, especially given that we've seen a pretty significant inversion of the curve now, and long-term rates that have fallen instead of increasing. So that is a basis that is much more fragile and makes us very cautious on bonds.
That's a pretty contrarian view. Seema, your thoughts on it?
I mean, look, I think there's some really good points made there. This is going to be a year where the Fed is unlikely to be cutting rates, at the earliest, right at the end of 2023. So maybe you don't see as much downward pressure on the long end as maybe you traditionally would, but I think there is still some downward path to go. So we do think actually that treasuries are a decent place to hide out. We also think that actually investment grade Right, so, you know, first half of the year still looks to be pretty resilient. You only get into recession in the second half of the year. So that means that credit spreads, although they widen a little bit, it's not as, you know, we don't see the kind of default activity that we could have seen previously. So I think there is an area for core fixed income to outperform. Certainly we have increased our exposure within the last couple of days, just an acknowledgement of that.
See, Michelle, Jean Bavin sticking with us. I'm preoccupied with the moves in foreign exchange. Look at these moves right now. Cable, sterling against the US dollar, 122.35. The lows of the year, 103.50 intraday. That was at the back end of September. Take euro dollar on the session, just through 105 briefly, 104.98 right now, up 0.9% on the session. But from the lows of the year, again at the end of September, we have gone from 95.36 to 104.99 in just a couple of months. And last month, the DXY, the dollar, through the month of November, worst month since 2010. Brutal. Coming up on this program, Secretary Yellen making her late night debut.
You used to be the head of the Fed, chairman of the Fed. What goes on in there? And you guys wear robes and sacrifice a goat, and then and right before the goat bursts into flames, it tells you the new interest rate hike that you're supposed to say.
That conversation up next.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
You used to be the head of the Fed, chairman of the Fed. What goes on in there? And you guys wear robes and sacrifice a goat, and then and right before the goat bursts into flames, it tells you the new interest rate hike that you're supposed to say. What is it? Why is it so secretive?
It was thought once upon a time, I can no longer remember why, but that monetary policy would be most effective if it was most secretive. And the truth is that the Fed never even announced to the public what decision they had made about monetary policy.
Janet Yellen, the former Fed chair, and now Secretary Yellen, of course, on The Late Show, on Stephen Colbert, on CBS. AMH with us down in Washington, D.C. Anne-Marie, is this the rehabilitation of the Treasury Secretary?
She's doing quite a lot of press, right? And she put to bed those rumors that potentially she would be departing the administration after the midterm elections yesterday at the Deal Book Conference, saying that she plans to stay on. And now what we know from this Colbert interview, Jonathan, that she's been practicing her signature to make sure it's legible, as opposed to those of her predecessors. And this is kind of a funny moment, right? Because she's this widely accomplished economist. She was the Fed chair. She's now the Treasury Secretary. She's been practicing her signature. But it would be historic when those bills come out in January, because it'll be the first female Treasury Secretary to sign our U.S. dollar bills.
If you don't remember what Jack Lew's signature used to look like, I suggest you all go on Google and have a little look at those weird squiggles that I still don't understand. Let's get to the news right now in D.C., where you are. Happening right now is that meeting between Francis Macron and the President of the United States. This is what Macron said to ABC a little bit earlier this morning, Anne-Marie. The US CHIPS Act and the Inflation Reduction Act were not properly coordinated with the European economies and create the absence of a level playing field. AMH, we anticipated there would be some tension on this issue. How do you expect it to play out today?
Yeah, first state dinner, Jonathan, since 2019, and tensions on the table along with the lobster. Listen, this is a big deal for not just Emmanuel Macron, but you've heard this from other European officials. They take aim at the U.S. CHIPS Act, they take aim at the Inflation Reduction Act, and the subsidies and the leverage it gives to American companies. And what Macron said in this interview with George Stephanopoulos of ABC News is that he wants to now synchronize the relationship. And his issue seems to be that the communication wasn't there before this legislation happened. And now that it's legislation, it is very difficult for the U.S. to go back on it and make it what Macron would say a more level playing field. Although the U.S. really pushes back on this, there's not much investment in this. Treasury Secretary Janet Yellen said just yesterday that she does not find this unfriendly because right now China has so much of the supply chain and that this is good for everyone involved.
Can we get a final word on strikes? If there's a man that knows something about strikes, it's the French leader. AMH, I wonder how that's going to play out between the two of them a little bit later.
Well, we have to wait for the Senate, and we could see that bill that was passed in the House that would make this legislation the tentative agreement that this administration talked about in September in the Rose Garden, that they were able to broker a deal between the companies and the unions. But at the end of the day, rank and file of all the unions did not sign off on it. It now goes to the Senate, and the tricky part is going to be not so much the tentative agreement, but the provision, Jonathan, on the Medicare and paid sick leave. Only 3 Republicans signed up for that provision in the House yesterday, even though the main agreement passed largely on a bipartisan vote. So you have this issue about individuals, especially on the progressive side on the Senate, like Senator Sanders. If that provision is not passed, will they vote no on the entire deal? And time is of the essence. It is December 1st, and they have a December 9th deadline.
Anne-Marie, final word. News conference a little bit later. What time is it?
I believe that news conference is in the 10, 11 o'clock hour, depending how the timing goes. So once again, there's policy that is interrupting very important games, especially Croatia and Belgium.
Very true. They need to speed this stuff up. I'm with you, Anne-Marie. Jay Powell was doing that yesterday, counter-programming with Argentina. Not on. Anne-Marie, down in Washington, D.C.
Poland, the Poland game.
I know, brutal. John Barvan and Seema Shah back with us for a final word. I want to come to the both of you on this, and it was from Deutsche Bank, looking ahead to next year. What are we getting wrong about next year? And this is where I start to look at consensus and wonder where the scope for upside, downside surprises are. Deutsche Bank said this: it's worth remembering that exactly a year ago, markets were pricing a Fed funds rate of 0.68% by the end of 22 and CPI at 2.6%. They went on to say, given the huge forecasting miss over the last 12 months, it's remarkable how settled the consensus is around a terminal of 5%. I went into the projections of the SEP for December last year, looking 12 months out, and the Federal Reserve itself had Fed funds at 0.9% at the end of 2022. Fed funds is likely to finish at 450. Seema, the final word goes to you on this one as well. What do you think we're getting wrong about next year?
Look, I mean, I think that's a tail risk. That is a clear tail risk. When we think about inflation, history tells us that it is almost impossible to get inflation once it goes above 5% down to 2% within 2 years, let alone 5 years even. So I think consensus is moving in slightly in the wrong direction. I think if I had a tail risk scenario, it would be that we get to the second half of next year, we have got inflation just falling very, very slowly still, and then the Fed has to introduce more rate hikes. The market has not priced it in at all, and I think that would be a very, very negative surprise. It's a tail risk, but we have to have it in the scope.
Jean, what about you? Lessons of 2022 looking out to 2023?
I would say two, and one is in line with what was just said. I think the idea that the Fed will be cutting in 2023, I think is very difficult to envision. So it's not for me a tail risk. I think this is like not in line with the baseline. And I think we're seeing more upside to the curve and the policy platform here. The broader lesson, and this is reflected in our outlook, is that we used to be approaching the year ahead with like a view about how to do tactical asset allocation in a way that would be holding up for the year. I don't think we can approach it this way. So we've spelled out like the scenarios we think might be panning out in 2023, and I think to get it right, it will be about like nimbly be willing to adjust and react to what's happening. But if I had to make a call, the biggest mistake we're going to make is expecting things to be so benign and rates peaking at 5. I think they're going to be peaking higher than that for policy rates.
So, John, how high?
No, I think we're going, I mean, we were not going to massively higher, but I think we can get like to the 5 range. I think that would be already pretty significantly different from what we're expecting now. And when you look at the range of historical outcome, I mean, that's not like very far from that peak, but it would be materially different from what the market's currently pricing.
Jean Bavin, brilliant to catch up with you, sir, on the new outlook for 2023 from BlackRock. Jean Bavin there, alongside Seema Shah. Equity markets look like this morning at 0.4%, about 7 or 8 minutes away from the opening bell, adding to the back-to-back monthly gains we had on the S&P through October, up around 8%, through November, up around 5%. The rally continues in the bond market, almost unchanged at the front end of the yield curve on a 2-year, up almost a basis point to 432 on a 10-year, down about a basis point to, let's call it 360, just to break a 360 this morning, and more dollar weakness. Euro dollar just south of 105, cable sterling against the US dollar 122.40. That's the price action. Coming up, the morning calls, and later Powell's remarks adding more than $1 trillion in market value to the S&P 500. That conversation with Chris Harvey of Wells Fargo around the opening bell.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Five minutes away from the opening bell as we kick off the trading day, and December, that's just around the corner. Futures are positive by 0.4%. As the price action, let's get you some morning calls. First up, Morgan Stanley, downgrading Capital One to underweight, growing more cautious of the consumer finance sector due to the challenging macro landscape. Your second call from Jefferies, cutting its Salesforce price target down to 230, pointing to the stock's limited visibility after results. We're down there by more than 7%. And finally, Citi downgrading Sirius Radio to sell from buy, cutting shares by 2 notches ahead of its potential combination with Liberty Live Nation. Their stock is down by 1.5%. Coming up, Chair Powell putting a floor under stocks, regardless of the upcoming inflation print. That's the view of Chris Harvey of Wells Fargo, and that conversation with Chris is up next. Equity futures just about positive. The opening bell just around the corner.
product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Closing out November with the first back-to-back monthly gain on the S&P 500 of this year so far, and looking to add some weight to that rally as we kick off December. Equity futures right now up 1/3% on the S&P 500, on the Nasdaq 100 up around about 1/10%. The small caps, the Russell, up 0.5%. Let's see opening bow, switch to the board and get to the bond market. 10-year Treasury yields through November down about 40 basis points. This morning up about 1 to 362.55. In the FX market, some real dollar weakness. Euro dollar through 105, positive 0.9%. Pound sterling against the US dollar up by 1.6% today to 122.56. I keep saying it, I know, but wow, what a turnaround from the end of September, from 103.50 to 122.50 on pound sterling. Quick look at crude, up by 2.6%, 82.67 on WTI. 30 seconds into the session, 30 seconds into December, equity futures are positive, and now stocks are too, up by more than 0.2% there and thereabouts on the S&P. On the Nasdaq, up by almost 0.1%. Let's talk about the new consensus. The long-time equity bull, Marko Kolanovic of JP Morgan, is starting to sound a little bit more like Mike Wilson of Morgan Stanley. Take a listen to this quote. Previous lows in equity markets are likely to be retested as there may be a significant decline in corporate earnings. We are inclined to think that this could happen between now and the end of the first quarter of 2023. Mike Wilson weighing in on a new consensus.
Our call this year now has become pretty much consensus, but that's why we flipped in October, quite frankly, is we felt like that call, the fire and ice call, right, Fed tightening into a slowdown, became consensus. Now we see kind of this idea that we're going to make a lower low in the first quarter. I don't think that's quite consensus yet.
Katie Lyons has more. Hey, Katie.
Hey, John. Well, just a reminder of where we've come in the last 2 months. First back-to-back rally, we have seen positive months for equity markets going back to the summer of 2021. And over the last 2 months, we've actually rallied about 14% on the S&P 500. But of course, as you said, it's a new month now. Will the rally go on into year end? If you look at the Traders Almanac, the Stock Traders Almanac, it finds that it's extremely rare for stocks to undergo heavy selling in December, which is actually the third best month for the S&P historically, going back to 1950, with an average gain of about 1.5%. And that does seem to be the consensus on the street as well, that the rally can continue. Happy holidays, everyone. But then when we get into 2023, it's a very different story. And to extend from what your conversation was with Mike Wilson this morning, he said he does think this rally can keep it up in December, but he thinks we could go as low as 3,000 on the S&P 500 in the first 3 months of the year. And JP Morgan, you read a little bit of that, the publishing from this morning, thinks we could test new lows in the first quarter, which could mean down 12% from here. And Binky Chadha is actually looking out even further over at Deutsche Bank. He thinks by the third quarter, the index will drop to 3250 in that period as the recession begins, which is 20% downside from where we are now. Then, though, he sees a rebound, and pretty much everyone else does as well. The average target on the street is actually that the S&P 500 is going to end next year very little change from current levels. But keep in mind, current levels still has the index down about 14% on the year, and typically in years where we see double-digit declines on the index, the next year usually brings a rebound, often a very sizable one to the tune of 20% or more. The question, John, as it always seems to be, is this time different?
Kelly Lyons, is it? Thank you. In October, the equity market was up 8% on the S&P. In November, the S&P was up by more than 5%, and we're all asking the same question, just how much upside is left in this equity market rally?
We've seen this big rally over the last sort of 6 weeks or so.
There's a huge relief rally.
I think we're probably getting towards the peak of that.
This year was all about valuations coming down and earnings hanging in there.
Well, we're clearly seeing this slowing down of the U.S. economy.
Next year is going to be some valuation relief.
I'm simply not of the belief that we have actually hit the bottom.
We still have a recession penciled in for the first half of next year.
Things are not, or the tang, Tom, but things are not looking good right now.
We're probably in for a period of below trend returns in the equity.
We'll start to see some disappointment maybe as we move into 2023.
There's never been a bear market that ends before the recession starts.
I do think that the low is in.
It's coming, but it's coming next year, not now.
Chris Harvey of Wells Fargo says stocks have more to run. This is what he has to say. Powell's remarks seem to have taken the teeth out of the upcoming November CPI report. The equity downside associated with a hotter CPI print becomes limited. Chris, I'm pleased to say, joined us right now. Chris, I guess we should start with the chairman yesterday. What did you learn from that delivery?
Yeah, so a lot of people are scratching their heads because you listen to what he had to say, and it's pretty standard fare. Hey, we're going to get to very restrictive. We're going to stay there until we break the back of inflation. The only thing he really added to it is the market believes he's blessed 50 basis points, right? And what does that mean? I think that means three things. As you point out, I think what it does, it takes the teeth out of the CPI report, because why were you afraid of the CPI? If it comes in too hot, then maybe the Fed goes another 75 basis points. They get a lot more hawkish and we see more downside. Well, we have to take the CPI off the table at this point in time, or really a lot of the downside off the table. Two, if you look at real rates have dropped like a stone, or they dropped like a stone yesterday. 10-year real rates dropped 22, 23 basis points. Why is that important? That's important because lower real rates have been associated with a better returns to growth. And what is the equity market? It's a growth index. And the last thing that we've been saying is the sell-off year to date is really about a cost of capital correction. It's not because the fundamentals have imploded, right? This is not 08 where we've seen companies like Freddie and Fannie and Bear Stearns and Lehman Brothers go belly up. What this is about is the cost of capital is more than doubled. So if you're lowering the cost of capital, which is what the market did yesterday, then you should see a pretty good pop because the fundamentals haven't broken. So all in all, you've taken the teeth out of CPI. You've lowered real rates, and you've lowered the cost of capital. In the short term, I think that's going to push the equity market up another 2 or 3% in the coming weeks.
Chris, hearing from Fed Governor Bauman, inflation is unacceptably high. The labor market is strong. You said we've taken the teeth out of the CPI print on December 13th. Have we taken the teeth out of the payroll story tomorrow morning?
No, I don't. I think any one data point, you can get a very big number, positive or negative, right? And the market will react to that. Market is still very sensitive. Like, good news in the job market is going to be seen as bad news in the equity market, right? But what's happening holistically and what's occurring? We've been talking about inflation. When do we start looking through these inflation prints? The market is now beginning to believe that inflation is rolling over. Inflation, the Fed has got it. Things are going to slow down. And I think that's part of what's happening right here. But to answer your point, yeah, any one print could be exceptional and move the market. But overall, what we're seeing in the job pictures, things are beginning to ease up. What we're seeing in inflation is all your leading indicators have rolled over and things are beginning to work.
Chris, do you think we're going to get a little bit too cute about the outlook, the trajectory for 2023? There is this new consensus that's been established, the idea that we get this first half of weakness off the back of bad corporate earnings and this second half of strength as the Fed starts to make a bigger pivot. Chris, I just wonder what you think about that.
Yeah, John, I think a lot about that. So in the summertime, we had this conversation. We had this conversation that numbers weren't going to go down, they weren't going to be as bad as expected, but you were going to see numbers come down in the beginning of 2023. and that was going to be weighing on equities. And I do think that's now become the consensus view. The thing that's changed now is we now have a better idea of when the Fed is going to end, where the top in rates will be. And during the middle of this year, there's a lot of questions. Well, we can't find an equity bottom if we don't know where the top of rates will be. Now we have a much better understanding of that. And I do think we're getting a little bit too cute. I do think it's becoming more consensus. And as it becomes more consensus, the probability becomes less. And so we've got to watch very carefully about what rates are doing. And that's going to be very important because of the growth component in the market and how sensitive or how duration sensitive it is.
Where do you think the greatest earnings challenge will be in the upcoming quarter?
I think it's going to be more so. You've seen some pretty good and some pretty big deratings on the growth side. I now think it's coming more so on the cyclical side. If you listen to Chairman Powell, and we're late in the cycle, and this is not unexpected, what he's looking for, what he wants, what he needs is an economic malaise. Because what he's saying is we've got to get that job picture down. The way to get the job picture down is to decrease demand, right? And so as a result, the economy is naturally slowing, but the Fed is going to force that. And where you're going to see the numbers change and change more so is on the cyclical side than the growth side. And what we're telling clients is you really want to go, if you're going to invest, you really want to go to where expectations have been lowered. And one of the places where expectations have been lowered more aggressively is on the small cap side. And that's something we're much more positive on today. We did upgrade small caps about 2 or 3 weeks ago, partly because expectations have come down pretty dramatically.
Chris, yesterday Microsoft up 6%, Apple up 5%, Tesla up 7%, Amazon 4%, Google 6%. What about big cap tech, Chris?
So we're still short software, right? We've been short software, or underweight software for the last year and a half. And what we've been saying is it's working, the risk reward is changing, and the dynamics that we're looking at for growth are beginning to change. So we're viewing these things, we're not as negative as we were before. We're viewing this as the risk reward is beginning to change, and as that risk reward changes, I don't know if tech is going to be that leadership, but I do think there's a lot of idiosyncratic growth stories that are very attractive. There's a lot of former high-flying growth companies that are now growth at the right price, and that's really what we want on one side of our portfolio. We want these GARPy names. We want names that can work in a lower growth environment where inflation is more benign, and they can power through the situation.
We want you back on this show soon, Chris, before year end. It's been great to catch up. Chris Harvey there of Wells Fargo. Thank you, buddy, as always. 10 minutes into the session, we're up 1/10% on the S&P. On the NASDAQ, we're up almost 0.2%. Shares of Credit Suisse, to pick out one single name, falling for a 13th consecutive session. Close here. Longest losing streak on record. Abby has more. Hey, Abby.
Hey, John. Well, this is really pretty incredible. As we have stocks rallying here in the U.S. 2 months in a row, we have the shares of Credit Suisse, both in Switzerland and the ADR here in the U.S., absolutely quietly plunging, and that record streak to a record low, as you were mentioning. The recent move lower, because this, of course, comes in a greater than 95% fall from the peak, has to do with the recent rights offering that could bring dilution. Now, before we speak more about that, the reason that they have the rights offering is a part of that $4 billion capital raise announced a few weeks ago for the transformation of the company, because, of course, they've been racked by a number of scandals. They've also talked about a fourth quarter loss potentially of $1.5 billion, lots of money coming out of their key asset management business. So lots of problems here, and Archegos was one of those scandals. Lots of fines paid over, not just the recent years, but they've had a lot of scandals and problems over the last decade or even longer. But as for that rights offering, John, 2.52 Swiss francs, that's the key level. If the stock in Switzerland can stay above that level, then perhaps the dilution will not happen. But if below that level, according to one analyst, it could really be a problem, and it will be interesting, John, because you can see that this recent selling, all of the selling, the last peak closer to 2,000, it's on higher volume. But if it holds that level, will investors see some sort of near-term trade there as this company tries to get itself together? But certainly catch a falling knife there.
Abby, thank you. Thank you very much. It's a challenge to hold on to clients in an environment like this one. We heard from the Credit Suisse chairman a little bit earlier this morning, who said we have had very few clients leaving. We will see client money coming back. We actually heard from the UBS chairman at a conference in London in the last 24 hours, who said we are not actively benefiting at their expense. He went on to say, We view them as a worthy competitor going through a crisis which I believe they will manage and get to safer ground, but we are also in a world of clients moving money around where clients proactively approach us. An indication from UBS that Credit Suisse clients are going to the bank proactively. The latest. I just can't believe we're seeing a two-handle on Credit Suisse this morning. More on that, no doubt, through the next month or so, going into a new year. Coming up on this program, investors turning their attention to Friday's payrolls report.
Recent research by Fed economists finds that the participation gap is now mostly due to excess retirements. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force.
That conversation up next.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
NEC was started under President Clinton, and Bob Rubin was the first person to hold that job. Can you explain to people what it actually does and what the NEC does day to day? When, for example, who's in the NEC, who's on the NEC, what is your job actually to do?
So the National Economic Council, the job, the mandate, the mission of the organization is to coordinate economic policy across the executive branch and across the cabinet to make sure that the president is getting the benefit of when making decisions of his entire economic cabinet, and also that the economic cabinet is getting clear direction from the president as well. So that two ways. So it's a coordination function. On the NEC itself are all of the relevant cabinet members, the sort of core economic team, OMB, Council of Economic Advisors, Treasury, but also Secretary of Labor, Secretary of Commerce. My team, the NEC team, is a small team within the White House that is, our job is to do that coordination across the range of economic policy issues.
Now, you were the deputy in the Obama administration at the NEC, now you're the director. Which NEC worked better, the Obama administration one or the Biden one?
Well, on the issues that I worked on in the Obama administration, it worked very, very well. And the current NEC works very well as well.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
Participation, however, remains well below pre-pandemic trends. Recent research by Fed economists finds that the participation gap is now mostly due to excess retirements, that is, retirements in excess of what would have been expected from population aging alone. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force.
Chairman Powell and investors alike paying close attention to the labour market. The US payrolls report less than 24 hours away. This is DoorDash plans to lay off 7% of its workforce, joining the growing list of tech firms cutting jobs. The CEO writing in a letter to staff, while our business continues to grow fast, given how quickly we hired, Our operating expenses, if left unabated, would continue to outgrow our revenue. Ed Ludlow joined us now on the West Coast alongside Mike McKee here in New York. Mike McKee, I want to start with the data ahead of payrolls Friday. It's the data we got just a minute ago.
Yeah, we just got the S&P version of the PMIs for manufacturing for November. Now, this is a final. It's 47.7. Their preliminary indication was 47.6, so marginally better, but still below the 50 line that theoretically tells us whether business is contracting or not. It is different construction a little bit than the ISM number at the top of the hour, but both will get some attention today.
I think we're looking ahead to the ISM employment component as well, given what happened with manufacturing and the ATP, and payrolls just around the corner. Speaking of payrolls, Ed Ludlow, the job losses in tech just piling up and piling up.
Yeah, the data is staggering. DoorDash, interesting because it's a company that continues to grow both in terms of bookings and the top line, but they're trying to unwind the pandemic era mega growth, right? It's a similar story in Amazon, trying to unwind the investments that they made, and they've become bloated, so they're starting to cut jobs. I actually want to get straight to the data, John, from Challenger Gray, because it is staggering. In the month of November, the technology sector announced almost 53,000 jobs to be cut, taking the year-to-date total to around 81,000. I'm actually going to say that again, John. 53,000 job cuts announced in tech in November, taking the year-to-date total to 80,000, all of it coming in the month of November. That is the biggest month since this firm, Challenger Gray, started recording that data set, and the year-to-date total of 81,000 jobs announced, the biggest since 2002. So something clearly happening very sharply in the technology sector. The other piece of data that really caught my eye, John, and I'm grateful to be on the show this morning for that reason, the majority of job cuts announced in November came from the West Coast in particular. And so that is worth looking into. Pay is also a really big issue right now because people are looking for new jobs. You know, we've been talking a lot, for example, about Twitter, those that left of their own volition and those that were laid off. Well, I know, talking to sources, the kinds of firms they're going to, but they're not able to command as high a pay as perhaps they had at their previous firm, which is an interesting dynamic when we think as well about inflation in the context of wages.
Hey, just how much excess is there? I saw a Wall Street Journal story over the weekend that was explaining just how much the likes of Amazon and Meta have grown through the pandemic. We're talking about a workforce that have basically doubled as some of these tech firms.
Yeah.
How much excess do we have left that we need to remove?
There is excess, and you know, I'm hearing from a lot of folks in this town and broadly out in the Bay Area that are struggling to find a job. But a lot of venture capitalists will say something else, John, which is that if you go back to the dot-com bubble, 2008, when you see layoffs like this, you actually release a lot of talent, and what that talent does is they found their own companies. Good companies are born out of recessions, and what's interesting is that dynamic itself is also offset by this idea that a lot of mid to late stage growth companies right now in the private space are also being told by their boards to have discipline and not hire like crazy. So it's a really hard balancing act, but yes, there's excess. I think what will be interesting, and we see to give, actually, is if they might be overdoing it a little bit. You take HP Inc. as an example, up to 6,000 jobs over 3 years, but what we're understanding there is that actually they want to give themselves flexibility, because if you cut too hard, you may not be able to hire those people back, and then you're left stranded if we see a quick turnaround in the economy.
Ed, thank you. Appreciate it, buddy, as always. Mike, I want to give you the final word on this as we push ahead to tomorrow morning. Mike, can we just start with Challenger? Maybe some people out there not familiar with Challenger job cuts. How useful is that data, Mike?
In a directional sense, it gives you an idea of how things are going, but they include potential job losses, not just from firing people, but attrition, and if you're cut back on hiring plans, it all goes into that. So it doesn't really mean that 81,000 people are losing jobs, but you want a final word on this. 81,000 jobs lost, even if that were the actual number in the month of November. Well, in the month of October, the economy cut 360,000 jobs. Now, we saw job gains because more people were hired, but that kind of churn goes on all the time, and you can see the relationship of the tech industry to the overall economy. 153 million jobs out there, so 81,000 isn't much. Gets a lot of headlines, but it's not really a story of what's going on in the labor market right now.
Final word on jobs tomorrow, Mike.
Well, I think what we're going to see is a slowdown. That seems to be the indication. We'll get a better look when we get ISM. You mentioned the manufacturing employment numbers. But it's also important to keep in mind that what happens is unemployment doesn't tend to rise until after the Fed stops raising rates and even starts cutting rates. So there's a very good chance that if we're going to have labor market problems, we haven't gotten there yet. So no matter what the numbers say tomorrow, it isn't going to be the final word.
ISM in about 8 minutes. Mike's going to break that down with Alex Steele, Guy Johnson, and the team in 8 minutes' time. Payrolls Friday, just around the corner. Equities right now about 22 minutes into the session, positive 0.4%. We add some weight to the rally through October, through November, now into December. The Nasdaq up by 0.5%. Let's get some sector price action. Here's Abby.
John, we have something interesting happening sector-wise that suggests that investors really do think that the Fed could back away. And what I'm talking about is we have utilities and real estate, two of the top 3 sectors up about 1% apiece. These sectors, of course, give high dividends, have these companies' stocks offer high dividends, and that would be competition to yield. So if this strength for utilities and real estate continues, it suggests that traders, investors think that yields will go down, perhaps on the Fed being less hawkish than previously expected. As for those 2 months, take a look at this, John. All 11 S&P 500 sectors higher for the quarter so far. Energy, industrials, materials, old school, old economy sectors leading the way. And then take a look. The worst sector, underperforming, up 1.4%. Discretionary as we still figure out what's happening with the U.S. consumer.
Abby, thank you. Stocks advancing, your trading diary. Up next.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the U.S. are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Almost 26 minutes into the session, stocks are up by 0.4% on the S&P 500. We advance once more. That's the price action. Here's the trading diary. Coming up at the top of the hour, ISM. Then the president and French leader Emmanuel Macron holding a news conference at 11:45. Fed Vice Chair for Supervision Michael Barr speaking at 3 p.m. More Fed speak. Arkin and Evans on Friday, and finally closing out the week with Payrolls Friday. All-star lineup on this program tomorrow. Do not miss it. Mohammed Al-Arian, Rick Reeder. We'll hear from Anastasia Amoroso and Michael Collins from New York City. That does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their